Good morning, everyone. It appears to be 8:30, so we're going to go ahead and get started. Welcome to today's webinar, Retirement Accounts and Planning for Inherited Accounts and for Marital Rights. We're happy to have Professor Chris Hoyt with us here today. A few things before we get started. You will have the opportunity to submit text questions to the presenter by typing your questions into the questions pane of the control panel. You may send your questions in at any time during the presentation. We will collect these and address them during the Q&A session at the end of today's presentation. I know that we have both members of the Sioux Falls Estate Planning Council as well as the State Bar in attendance here today, so thank you all for attending, and thanks to both organizations for their support in making this event possible today. Lawyers Concern for Lawyers is a confidential, independent source for South Dakota lawyers, law students, and their families. Do you or a lawyer law student you know have a drug or alcohol problem or are struggling with depression or anxiety? Lawyers Concern for Lawyers volunteers are here to help, are independent of the State Bar, and your referral or visit with us is strictly confidential and privileged. Call Becky Porter for more information at 605-391-5191. Becky is a Lawyers Concern for Lawyers member, and your communications with her are likewise confidential and privileged. With that, I would now like to introduce our presenter, Chris Hoyt. Chris is a professor of federal taxation, business organizations, retirement plans, and tax-exempt organizations at the University of Missouri, Kansas City School of Law. Prior to entering academia, he was in private practice. If you're ever in the Kansas City area, look out for Vanity Plate 501C3. That is Chris's personalized license plate. So if you see that one around the area, you know that's his. We're very happy to have Chris here today to talk about retirement plans and inherited accounts, marital rights. Thank you very much for attending, Chris, and thank you for your flexibility with participating virtually.
Thank you, Joe. Thank you so much. I sure wish I could be in South Dakota right now. And thank you for sponsoring this and for all the great help you've done. But this is a pandemic, and we'll see how things go. I did get the email that the Heckerling conference in January has been moved to May, and they plan to do it in person. So at least the people at Heckerling hope we can travel in May, and we can get airplanes. You know, a month ago, Kim Kardashian flew coach, and she hadn't flown coach before. And so as she checked in, somebody said, "Miss Kardashian, that'll be an extra $35. And Kim Kardashian said, $35 for what? And they said, $35 for a checked bag. And Kim Kardashian looked down at her bag, and then she said, how much for a striped bag? Okay, I'm dying here. This is going to be tough. But as my grandmother used to say, when life gives you lemons, make lemonade. And I follow that advice, but I add tequila. That's how I deal with it. So seriously, I do hope that each of you is healthy and your families are healthy. We read about, South Dakota having an outbreak after the Sturgis rally, and I just wish you all the best. Personally, I'm taking precautions. This is a great drug I'm taking every day, and I think it's going to help. When I can't go to sleep at night, I take this little orange pill my wife gives me, and I fall right asleep. And in the morning, if I'm groggy, I take the same orange pill, and I'm wide awake. And then if there's flu symptoms, they disappear. Cold, aches, and pains go away. I don't know where she buys it. She just told me the name, and the name of it is placebo, and it's fantastic if you need something like that to work. So I know you're having great, I gotta open with this stuff. I know you're having great weather in South Dakota. The high will be in the 60s today, compared to our poor friends in the southeast with Hurricane Sally. And this is the last thing before we launch into the presentation. But there has been a study saying that maybe people don't evacuate their homes because the names are so friendly. Sally, Harvey, Irma. I knew Irma. She wouldn't hurt me. And so the suggestion is that next year we should give them hip-hop names, like Busta House. Okay, I'm going to evacuate. But the next one coming is Teddy. We're going to go to the Greek alphabet again. So let's get started. Let me tell you what we're going to do, our timetable. We'll have 2 breaks. The first break will be at 9:40. We'll have a 10-minute break, resuming at 9:50. And then we'll have another break at 10:50, resuming at 11. And then you'll be done by noon. And one thing I've learned is that students and people at programs like this are the only class of consumers who want to get a little bit less than they pay for. So we might actually end a little bit early. Let me tell you what we're going to cover in the next 3.5 hours till 12 o'clock. We're going to look at the new rules and planning implications of recent legislation, the CARES Act and Secure Act. And then we're going to look at outcomes and specialist planning strategies when the beneficiary of a retirement plan account is a trust. And one thing we're going to look at is with this new 10-year liquidation of retirement plan accounts, the idea of naming a tax-exempt charitable remainder trust as the beneficiary, moving your retirement assets from one tax-free trust, the IRA, into another tax-free trust, the charitable remainder trust, that can pay income for the life of the child rather than just 10 years. After we go over the basic rules, we'll look at the special rules that apply to married couples. What are the rights that you have in your spouse's 401k plan and your spouse's IRA? They're different because they're covered by different laws. Conversely, what is your spouse's right to your 401k and your IRA? And then finally, the last hour, we'll look at the rules on donor-advised funds, which have just exploded in popularity in the last 3 years. In 2016, there were about 300,000 donor-advised funds. Now there's about 800,000 and more, and they're growing. So if you just set one up, if you are advising clients who set them up in the last few years, what are the rules that cover them? So that's what we're going to cover. And of course, you all know that there were 2 major legislation changes in the last year. The CARES Act, the $2.2 trillion legislation to deal with COVID-19, and then the Secure Act, which was enacted in December of 2019, that made a lot of changes to retirement plan accounts. So for the CARES Act, there were 2 changes that affect your retirement plan accounts. The first is there's no required minimum distributions in the year 2020. This applies to people over the age of 70 and a half, and also people at any age who have inherited a retirement plan account. You don't have to take anything out this year. Your pension plan still has to pay your pension, but your IRAs and the like don't have to have any distribution. Second, with regard to 401k plans, we're going to talk about how restricted the access is to them. If someone in your family has lost income from a layoff, a business closure, a quarantine, reduced hours, or inability to work because they had to take care of children, or if someone in your family has been diagnosed with COVID-19, then 2 things. First, that is eligible for hardship distribution. You can go to the plan and say, I need money, and get a hardship distribution. The distribution is taxable income, but there will be no 10% penalty if you're under the age of 59 and a half. Second, if you just want to borrow money, and also you can pay it back over 3 years rather than pay tax on it if you choose. Also, if you want to borrow from your plan, the limit of $50,000 as the maximum you can borrow from your account has been increased to $100,000 you can borrow from the account if you have a lost income or a layoff or business closure. So let's go back to the generic estate planning. And we're going to look at changes that affect lifetime distributions, which are distributions from your own account because you're over the age of 7, well, just because you're retired. And then the changes the estate planners face for inherited accounts as people named beneficiaries of their retirement plan account. So for those lifetime distributions, those required minimum distributions, there are 3 changes effective this year. The first is the new age for minimum distributions is age 72 for people who attained age 7.5 after the year 2019. Now that said, you are allowed to make a gift to a charity from your IRA and exclude it from your income and they're keeping the old age of 70 and a half. So someone who's 71 years old this year doesn't have any required distributions, but they can make a gift to a charity from an IRA and exclude the gift from their income. Second, as we just mentioned, there are no required distributions in the year 2020 from your own IRA if you're over the age of 72, or from an inherited IRA or inherited retirement account. And third, when those required distributions begin next year in 2021, we will be using new life expectancy tables that add about a year and a half to our lives. So that means those distributions in 2021 will be smaller than the distributions that were required in the year 2019. It goes down something like 1/3 to 0.5% every year. So for example, here are the required distributions people had to take out in the year 2019. And you can see in your 70s, the minimum distributions are pretty modest. You had to take out between about 4 and 5% every year. In your 70s, in your 80s, you have to take out between 5 and 9% every year. So if you were still earning 7% on your money, you weren't dipping into principal until you're about 85 years old. Take, for example, someone who turned age 80 last year. The minimum distribution was 5.35%. So you figure out what's the beginning balance, or basically the closing balance on December 31st of last year. So the first day of the new year, you have $100,000. Second question we ask is, how old will you be at the end of the year? Somebody's going to be age 80 at the end of the year. They then take $100,000 at the beginning of the year times 5.35%. They had to take out $5,350. Next year, an 80-year-old only has to take out 4.95%. So you have in the 4 handouts here, and the 13-page handout has the distributions for every age. I just put them here in increments of 5 years, but you can look at the distributions for next year. Another change made by the Secure Act is to allow working seniors the ability to get tax deductions for contributions to IRAs. For whatever reason, if you're still working in your 70s or 80s, you could put money into your company's 401k plan. You could put money into a Roth IRA. With a Roth IRA, there's no tax deduction. But there was a law in the book that once you attained age 7.5, you couldn't put any money into a traditional IRA and deduct the $6,000 or $7,000. The annual deduction limitation is $6,000. If you're over the age of 50, it's $7,000. So obviously here, they could put in up to $7,000. Well, now you can put in $7,000 and deduct it on your taxes if you're still working in your 70s, 80s, or 90s. But there's a catch. And the catch is that if you ever want to make a charitable gift from your IRA, and they call it a QCD, a qualified charitable distribution. If you ever want to make one of these gifts from your IRA and have it be tax-free where it's not included in your income, then you should never, with a capital N, make a tax-deductible contribution to your IRA after you're 70.5 years old. Why not? Well, under the Secure Act, if a person ever makes a tax-deductible contribution to an IRA after age 70.5, then the amount of the future qualified distributions from the rest of their lives, the amount of these distributions that can be excluded from taxable income is reduced dollar for dollar for every dollar of deduction you took. I'll give you an example that makes it real clear. Here's the statute. It says the amount of distributions not includable in gross income for a gross year shall be reduced by an amount equal to the excess of the aggregate amount of deductions allowed to the taxpayer under Section 219 for all taxable years ending on or after the date the taxpayer attains age 70.5. I'll go through an example. What's going on here? Well, how do you get tax breaks from your charitable gifts? And that is my license plate, 501c3. And I was hoping to take it to South Dakota, but I'm here. To get a tax break for a charitable gift, you have to itemize your deductions. And with this new tax act, as you all know, fewer people can itemize. And only 11% of tax returns are itemized. And for seniors, it's less than that, because what are your itemized deductions? It's your state and local taxes, and of course, South Dakota does not have an income tax. State and local taxes, your charitable gifts, and your mortgage interest. Well, the seniors have paid off their home mortgage, so they take the standard deduction. So a senior says, I got an idea. I will put $7,000 into my IRA this year, and then I'll give away from my IRA $7,000. And then indirectly, I can deduct my charitable gifts with a IRA contribution. So to stop that, they passed this law that if you ever make a gift to an IRA, a contribution to an IRA after 7.5, that reduces your tax breaks for the rest of your life. So people in their 80s and 90s will need to keep their tax records ever since age 7.5 to compute their tax return in their 80s and 90s. Just don't do it. So here's an example. iWork has minimum distributions this year and next year of $5,000. Every year, this year and next year, she's got to take out $5,000. And she has a check for $5,000 leave her IRA and go to a charity. Calls up the IRA administrator, cut a check from my IRA at First National Bank, payable to such and such a charity. So she doesn't get it. $5,000 this year, $5,000 next year. She's employed. And this year, she puts $7,000 into her IRA and she deducts it. Next year, she doesn't put anything into her IRA. So the question is, as those two checks for $5,000 go to charity this year and next year, how much can she exclude from her taxable income? And how much of those checks to charities are taxable? Well, this year, when the $5,000 goes to the charity, she has to include it in her tax return. Next year, when the $5,000 goes to the charity, the first $2,000 will be taxable, but she can exclude from her income $3,000. Now, those two taxable distributions, the 5 and the 2, when that happens, she can take an itemized deduction for her charitable gifts. But the point is, she doesn't itemize. And so basically, she'll pay income tax on the $5,000 or the $7,000 that went to charity. So what should you advise your clients? First, at the top of the page, if you want to make a charitable gift to your IRA at any point in the rest of your life, don't take a tax deduction for putting money into your IRA. Don't contribute after age 7.5. What can you do if you're a working senior? You can put money in your 401k plan, not a problem. You can also contribute to a Roth IRA where there's no tax deduction, as long as your income is low enough. If your income is under 139,000 single, 206,000 married. Also, if you're self-employed, like an Uber driver or attorney or whatever, you can contribute to one of these SEP IRAs, and that's like a profit sharing plan using your IRA. That's okay. That's not putting your traditional $6,000 or $7,000 into your traditional IRA. The SEP IRA can have larger distributions. Just don't make a check payable from your SEP IRA to a charity the same year you put the money into the SEP IRA. So the SEP IRA has a same year restriction. No charitable distributions that you put money in. The IRA has a lifetime problem. And finally, as a practical matter, you who are watching this probably don't have to worry about this, because upper income taxpayers who are employed can't make tax deductible contributions to an IRA if they have a plan at work. And if their income is over 124,000 married or 75,000 single, you're not allowed to get a tax deduction for putting money into an IRA. But if you have friends or family or clients who have income under those thresholds, or who have no plan at work, then just warn them that if you make a contribution to your IRA for the rest of your life, you're going to have problems making a charitable gift from your IRA. So let's look at these changes and let's do the estate planning for the inherited IRAs. The Secure Act had one of its linchpins, try to get lifetime income from your 401k plan. The laws are pretty good about letting you build up your retirement assets, but we have a real problem of converting your retirement plan account into a steady stream of income. only 17% of 401k plans offer annuities. And so everybody's supposed to be like an independent investment advisor and specialist to invest their own assets. So we're hoping that more 401k plans will offer annuities. Second, we changed the RMD age to age 72. We talked about this already. Third, we allow working individuals over 70.5 to put money into their IRAs. We talked about this already in the trap for charitable gifts. And then there are some other changes made to retirement accounts and 529 college savings plans. So you all know about Section 529 college savings plans, where there's no tax deduction when you put the money in the account. But if the money, the investment income in the account is spent on college education, tuition, room and board, even computers, then the investment income will be tax-free. If the investment income is spent on something other than college expenses for the beneficiary, the child or the grandchild, then number one is taxable income, and number two, there's a 10% penalty. So somebody put $20,000 in a 529 plan, it grows to $30,000, there's $10,000 investment income, they take it out and they spend it on the car, then they'd have $10,000 worth of income and a $1,000 penalty. Well, they added two new things that qualify for the exclusion. The first is you can pay off the student loan of the beneficiary. So if there's a child or grandchild as the beneficiary and the child or grandchild took out a student loan, and you have money left in the 529 plan after they graduate, you can spend up to $10,000 per beneficiary for a lifetime. That's the most you can do. So if you have 3 grandchildren or 3 children, you can spend $30,000 on each loan, but you can't spend $33,000 or $36,000. The most you can spend in your lifetime is $10,000 on the loans. Also, if you have a child who's not going to go to college, then you can use the money for apprenticeships, for expenditures they have in the apprenticeship, supplies and tools and things like that. Another change is if somebody has a plan at work, like a 401k plan, and they have given birth to a child or adopted a child. If they have given birth to a child or adopted a child, they're allowed to take out $5,000. It'll be taxable income, but at least there's no 10% penalty for taking money out in the year of a birth or an adoption. Another change is for the kiddie tax. As you all know, when a child under the age of 19 or a full-time student under the age of 24, if they're claimed as a dependent, then if they have too much investment income, the investment income is taxed at a higher rate than most people. And the amount is $2,200. So I'm going to round it to $2,000 just to make the math simple. If a child has $5,000 of investment income, what they used to do is they said they would go to their parent and they say, Mom and Dad, if you had $3,000 more of interest, dividends, and capital gains, how much more income tax would you, my parents, pay? I said, child, if we had $3,000 more of interest income, we'd pay a 32% tax rate. Thank you, said the child. Child prepares a tax return with $5,000 of income and basically pays the 32% parents rate on that extra $3,000, the amount of investment income that exceeds $2,000. So they wanted to simplify the law because now the child has to wait until the parent files a tax return, like on extension until October 15th. So they said, let's just have a child pay trust and estate rates. Well, that backfired, and I won't go into all the details. But so for the year 2020, we go back to the old rule. The child with $5,000 investment income will ask the parents, if you had an extra $3,000 of income, how much tax would you pay? And then they'll pay the parents' tax. In 2019, if you still have a tax return on extension until October 15th, you have the choice. Do you want to use trust and estate rates, or do you want to use the parents' rates? And in 2018, when we all use the trust and estate rates, you are allowed to amend your child's 2018 return to get a refund if the parents' rate would have been less than trust and estate. So the kitty tax is back to the old rules. That's the bottom line. And again, I'm going to round numbers to make it simple. My dad, I got family issues with math. My dad once said to me, son, you can divide the people of this world into one of three categories. There are those who know how to count. There are those who don't. I never forgot that. That's the heritage I come with. By the way, if you want really precise numbers, and when we can travel again, you want to go to Chicago, and you want to go to the Field Museum of Natural History. And when you walk in the Field Museum, the first thing you see is the world's largest skeleton of Tyrannosaurus rex bones. And I think you in South Dakota know, I'm not making this up. In South Dakota, you have more Tyrannosaurus rex fossils than anywhere else in the world. South Dakota is just where the fossils are, and that's where they found Sue, and they took her to the Field Museum. And so there's a young married couple, they go up to the security guard, and they ask the security guard, how old are those Tyrannosaurus rex bones? The security guard said, those Tyrannosaurus rex bones are 67 million, 6 years, 3 months, and 2 days old. The married couple were impressed. They said, how can you be so precise? And the guard said, well, on my first day on the job here, they told me those bones are 67 million years old. And I've been working here now for 6 years, 3 months, and 2 days. Incidentally, maybe it's not true, but I heard a story about a bus going through South Dakota. And the bus driver announced that if you look to your right, you can see some footprints left by Tyrannosaurus rex. And this one guy in the back of the bus got real agitated. His wife turned to him and said, why are you so agitated? And he said, I didn't think it came this close to the highway. That was his reaction. I'm dying here. I just can't see if this is working or not. Okay, so let's go to what you all signed up to listen to. The Kill the Stretch IRA. Qualified retirement plans and IRA accounts will generally have to be liquidated by the end of the 10th year after death. There are no distributions in years 1 through 9. All we do is look at, is there any money left on the last day of the 10th year? If there is, there's a 50% penalty. And so like if on the last day of the 10th year, there's $100,000, there's a $50,000 penalty. So you want to comply with this law. So we call this the end of the inherited stretch IRA. And why do we care? You know, when a person dies, you normally want to transfer the property from, you know, the probate estate or from the trust to the beneficiary, so now they can own the property. The problem is that with other property, you get a step up in basis. If grandpa bought the farm in the 70s for $30,000, now the farm is worth $1 million. When they sell the farm, their tax basis is the $1 million, not the $30,000. But when you inherit a retirement plan account, it's income in respect of decedent. The distributions from the IRA or the 401k plan are taxable income to the beneficiaries. So your uncle put $1,000 into an IRA while he was working, took a tax deduction. It grew to $3,000. That's okay, investment income is tax-free. And the idea was that when your uncle retired, he would have taken the $3,000 out and paid income tax. But your uncle never paid the income tax because he died. And you inherit the $3,000. So you have to pay the income tax your uncle never paid. Just the opposite of every other inherited asset that gets a step up in basis. Distributions to you are taxable income. So what's your objective? And normally, your objective is to defer paying income taxes to get more cash flow, more investment income. So for example, suppose your uncle had a $100,000 401k plan at work. And the company says, here's your uncle's 401k plan, here's $100,000. And then you pay income tax at your tax rate, 20, 30, I have here 40% to make the math simple. Of course, this would assume like a state income tax rate. The highest income tax rate is 37%. So you have $60,000 left over. You then invest the $60,000 and earn 10% a year, you have $6,000 a year. What if you left the money in the 401k plan, $100,000, and you earned the 10%? Then you could have had $10,000 a year. Which would you rather have, 10,000 a year or 6? I'd rather have 10. And the point is, as long as you can defer paying that $40,000 of income tax, you can earn investment income under $40,000. So that's your objective, is hold out for the whole 10 years. We'll talk about that in a minute. With the Roth IRA, the distribution's tax-free. So when you inherit a Roth IRA, the distribution's tax-free because the tax was paid when your uncle put the money in the account. And so they could give you the $100,000 and you'd have no income tax. But look at the $10,000 a year you earn on the Roth IRA. If you'd left the money in the Roth IRA for 10 years, you'd have $10,000 a year of tax-free investment income. By taking the $100,000 out and putting it into your brokerage account, now your $10,000 of interest, dividends, and capital gains are all taxable. So whether it's a taxable account or a Roth account, your objective will be to keep it in the account as long as possible. But we got these required distributions where the IRS tries to get the money out faster. So we used to have something called a stretch IRA. When you inherited an IRA, you didn't have to take the money out in 1 year. So the old term of stretch IRA means an inherited retirement account, typically an individual retirement account, where payments are gradually made over the beneficiary's life expectancy. And until the enactment of the Secure Act, it was fairly easy for any beneficiary who inherited a retirement account to receive distributions until the age of 83. And if you were older when you inherited it, you could defer distributions till age 85, 90, 95, something like that. So new rules apply beginning in this year, the year 2020. And we're going to compare the rules of the present, the past, and the future. And this is my last joke for a while. But the present, the past, and the future went into a bar. It was very tense. Sorry. Tonight you'll get it. So here's the general rule. When you inherit a retirement plan account, the maximum time period to empty the account is 10 years. And there's no required distribution until the 10th year. And the account needs to be empty by December 31st of the 10th year after the decedent's death, or there's a 50% penalty. So if someone died in June of 2020 or September 2020, the account has to be empty on December 31st, 2030. You actually have more than 10 years. You still have the remaining months of 2020 to invest the assets. This law applies to all sorts of qualified retirement plans. It applies to Section 401A plans, which are employer plans, profit sharing plans, stock bonus plans, ESOPs, and of course the most common is a 401k plan. It also applies to IRAs, which are taxed under Code Section 408, individual retirement accounts, which is different from 401, and then tax sheltered annuities and government employees with 457B plans. Now, that does not give you the right to compel the employer to keep the money for 10 years. The company policy might be that we're going to liquidate your uncle's account in just 1 year, because national employers like Verizon, McDonald's, Coca-Cola, they don't want to have to keep accounts for 10 years. And they might have a policy that when an employee dies, we liquidate the account in just 1 year to get it off the books. So they might say, your uncle died last year, we're going to cut you a check for $100,000. If you have an IRA at a quality institution in South Dakota, and you have so many quality financial institutions in South Dakota, you don't have that problem, because with an IRA, they'd love to have you as a client for 10 years. It's just a problem with companies when you inherit money from a company account. So if you learn that your uncle's $100,000 401k plan is going to be paid to you, you have the legal right to say, stop. Do not cut a check to me. I want you to write a check instead to an IRA at a South Dakota financial institution. And then you can take the money out over 10 years instead of being taxed in 1 year. So the beneficiary of an employer plan account can compel a transfer to an inherited IRA, and then you have 10 years instead of getting money just in one. So this is the general rule. For people who die in 2020 and later years, we have to liquidate the account in 10 years. There's no required distributions in any of the years. We just look at the last day of the 10th year. But what is life without exceptions? So Congress created exceptions for 5 categories of beneficiaries. And these are called eligible designated beneficiary. Now, a designated beneficiary is a tax term for a human being, you, me. And 5 human beings get special tax treatment. Now, if you're an eligible beneficiary, you can't wait until the last year. You have to take a minimum distribution every year, computed based on your life expectancy, the life expectancy of the eligible designated beneficiary. So the first eligible designated beneficiary is a surviving spouse. We're going to be talking a lot about doing a rollover where the surviving spouse, the widow or widower, rolls it over into their own IRA. But if they leave it in their deceased husband or wife's account, they can take it out over more than 10 years, leaving it in the account. If you have the deceased account payable to a trust, you're going to be looking at these rules, a trust for the surviving spouse. So surviving spouse is an option that no other beneficiary has. She or he can roll over the deceased spouse's retirement assets to her or his own IRA and have creditor protection. I'm not sure the law of South Dakota, but the Supreme Court said inherited IRAs do not protect creditors. You roll over to your own IRA is protected under South Dakota law. Other beneficiaries can't do that. They just have a 10-year liquidation period. Now, there are 2 times where it might make sense not to do a rollover. Your normal reaction is to do a rollover, but that's going to be the best thing with better creditor protection. But the 2 times you might want to leave the money in the deceased spouse's IRA or 401k plan is, number 1, a widow or widower under the age of 59 and a half. What happens to you and to me if you're under the age of 59 and a half and you take money out of your own retirement plan account? Not only do you have taxable income, you have a 10% penalty, which we'll spend some time on. So my favorite court case on this is Peggy Sears. Peggy Sears' husband died with an $800,000 retirement plan account. She was 53 years old. She rolled it over into her own IRA and she took out $60,000. And then the IRS said, not only do you have $60,000 worth of income, you have to pay a $6,000 penalty, 10% penalty. She said, it's all my husband's money. They said, yeah, but you rolled it over to an IRA. You took money out of your own IRA. So if she'd taken the money out of her husband's account, she'd have $60,000 of income, but no 10% penalty. So that's the first situation. And with a widow or a widower who's under age 59 and a half, like her, rather than roll over everything or roll over nothing, a blend might be the best approach. You might go to her and say, now, Peggy, you're 53. How much money do you think that you could save for your own retirement? And how much money do you think you might need before you're 59 and a half? And she might say, well, I can safely roll over $500,000, but I'd sleep better at night knowing I could get my hand on $300,000 at any time. Okay, let's roll over $500,000 to her own IRA. She can name the beneficiary. She can do her estate planning with that. Leave $300,000 in her husband's IRA. And then when she's 59 and a half, roll over the rest. And that way she's got better creditor protection in her own IRA. She can do estate planning with her own IRA, but she has the money free from the 10% penalty. The second time you might want to leave money in the deceased spouse's account is when you have a married couple with an age spread and the younger spouse dies first. So for example, let's say we have a 74-year-old married to a 65-year-old. And the 65-year-old dies first. If the 74-year-old rolls over the deceased 65-year-old's assets to her or his own IRA, well, that 74-year-old is over the age of 72 and has to start taking minimum distributions. You're going to see in a minute that if a spouse dies before age 72, the surviving spouse doesn't have to take money out until the year that that spouse would have been 72. And thus the 74-year-old could leave the money in the IRA for 7 years and take out no distributions. So if the surviving beneficiary of the account, then 3 tax breaks apply. The first is the spouse can recalculate her or his own life expectancy. Like at age 50, it looks like I'll die at 84. At 60, it looks like I'll die at 85. At 70, it looks like I'll die at 87. At 80, it looks like I'll die at 91. You can do that and never have to liquidate the account. Also, if the spouse didn't take money out of the account, there's a tax break here where you can clean up the mess. So suppose you have 2 individuals who are both 74, one dies, and for 3 years the survivor takes nothing out of the account, but was supposed to take minimum distributions. We can say, well, with that IRA, it looked like she thought she did a rollover, but she didn't. She was treating the account as her own, but it wasn't yet. So let's do the paperwork now, and there's no penalty for not taking distributions out. And then third, as we pointed out earlier, if the decedent spouse died before age 72, there are no required distributions until the year the deceased spouse would have been 72. And you don't have to take anything out. So Peggy Sears, if her husband was 53, she doesn't have to take anything out until she's 59 and a half. She can just use it as a savings account until she would have been 59 and a half. So that's the surviving spouse. And we'll spend a lot more time on that after the break, which is coming in 20 minutes. So the other 4 eligible beneficiaries are first a minor child, not just any minor child of the decedent. So if the grandparents name a grandchild as a beneficiary, it doesn't qualify. It's 10 years. So you're probably not going to see this too often because what we have to have happen then is that both parents die. And so typically the surviving spouse would get the rollover or some situation where there's no older person to take care of the minor child. So a minor child of the decedent. The second is a disabled individual. And this is the tax definition. Disabled, they can't earn any money. They can't have any income. Also a chronically ill person who tends to have a problem like bathing themselves, dressing themselves. And these are the type of people who we would have set up a special needs trust for. More on that later. And the last category is a beneficiary who is not more than 10 years younger than the decedent. So the most likely people here are partners who are living with each other who are not married. And people tend to live with each other in roughly the same age range. And so somebody could name their partner as a beneficiary of their child fund account. Also, people who are childless might name a sibling, and the sibling might be not more than 10 years younger. And the sibling or the partner can take the money out over their life expectancy to age 83, 85, whatever the number is going to be. You'll see them in a few minutes. So a few observations here. Yes, these 5 people, an eligible designated beneficiary, or we'll call them EDBs, can take distributions over her or his life expectancy. First tweak is that with a minor child, although a minor child has a life expectancy at age 83, once they attain the age of majority, the 10-year clock starts. Now, the regulations haven't been issued yet. In most states, the age of majority is age 18. And what that would mean is if the regulations say this, the account has to be empty at age 28. And so what you might do is you might take out those minimum distributions like 170th, 169. And then when you turn age 18, you might have some sort of protection that stops them from wasting the money to kind of keep it in the IRA until age 28 or something like that. But the 10-year clock starts once they attain the age of majority. There is a possibility that if their full-time student is age 26, and then we can wait till age 36. But again, we'll have the regulations come out and tell us the rules. The second issue is that when one EDB dies, one of these 5 people, then the 10-year clock starts for the successor. Even if the successor is also one of these 5 people. So the most likely scenario for this would be someone dies childless and names their brother and sister as successor beneficiaries. Example, 80-year-old dies and names his 78-year-old sister as the beneficiary. And then as the contingent beneficiary, if my 78-year-old sister dies, it goes to my 76-year-old brother. So first the sister for life, then the brother for life, well, for life expectancy. The 78-year-old is an EDB. She is less than 10 years younger, and the 76-year-old brother is an EDB. 78-year-old sisters, they're both EDBs. But suppose the 70-year-old sister dies next year, and now the brother's a beneficiary. I'm sorry, you're stuck with 10 years. You can't use the life expectancy of the deceased sister. So the popular press has told you these rules. It's 10 years, so there's 5 eligible beneficiaries who can get it out over more than 10 years. But what the popular press has not told you is there's 2 other time periods over which you might have to liquidate a retirement plan account. You might not have 10 years. You might only have 5 years. And that's law. That's not that, it's not a policy, it's law. And the last time period over which you liquidate the retirement account is what people are calling a ghost life expectancy. And let me tell you what it is. We'll spend some time on it. But a ghost life expectancy is the remaining life expectancy of someone the decedent's age. So for example, suppose we have a 76-year-old who dies and they got a retirement plan account. What's that person's life expectancy? It's 0, they're dead. But what we do is we go to the life expectancy tables, and the life expectancy tables say that a 76-year-old has a life expectancy to age 90, or 14 years. And all it means is half of the 76-year-olds in the world will die before age 90, like this one did, and half of them will die after age 90. That's what life expectancy is. So rather than liquidate the IRA over 5 or 10 years, we liquidate the IRA over 14 years. So there's a minimum distribution every year. So to understand which of these 4 time periods applies, you need to understand 4 definitions. The first definition is something called the required beginning date. The required beginning date, or RBD. And the required beginning date for you and for me is April 1, the year after you're 72. Now what that means is the year that you're going to turn 73, April 1st is the first day the IRS can whack you with a 50% penalty for not taking out a minimum distribution. So the law is that when you and I turn 72 years old, we're supposed to take out a minimum distribution. We might have been caught by surprise. We didn't know it. So they give us a grace period of 3 months, January, February, and March. You can take the money out in January, February, and March, the year you turn 73, to make up for the fact that you didn't take the money out when you're 72. But if you haven't taken it out by April 1st of the year after you're 72, then there's a 50% penalty on the shortfall of what you didn't take out. That's the first definition. The second definition you need to know is the definition of what's called a designated beneficiary. And a designated beneficiary is a tax term for a human being. You, me. But there can be beneficiaries of a retirement plan account who are not human beings, like the probate estate, like a charity. And in that case, we might have a beneficiary that's not a human being. And normally the best tax outcomes happen when all beneficiaries are human beings. So somebody in South Dakota says, I have a retirement plan account. I want half to go to a charity. That's not a human being. The other half to go to my daughter. So we got 2 beneficiaries. The daughter is a designated beneficiary as a human being. The charity is not. So how do we solve this problem? The way we solve this problem is we don't care who the beneficiaries are on the date of death. What we care are who the beneficiaries are on a future date called the determination date. And it's September 30, the year after death. Now, there's some other dates, if you know IRAs, October 31st and December 31st. But if you're just keeping in mind September 30th and get everything done by then, everything's going to be okay. So what this person says, I want half to go to a charity, I want half to go to my daughter. The best outcome happens if the daughter is the only beneficiary on September 30th, 2021, if somebody died in 2020. Now, I went to a school, and that school is asking me to name it as the beneficiary of their retirement account. And they said, just 1%. I got this mailing. Just name us as a beneficiary of the retirement account. And you know, I might do it just to be found. Maybe you don't know the story of the airplane that flew over the Pacific Ocean, and the pilot was flying and said, "Ladies and gentlemen, we have a crisis. We're gonna have to land in the Pacific Ocean." But the good news is that I see an island where I can land by this island, and I can safely land in such a way you can all get onto the island. The problem is the island is not on the map. They might never find us. We might spend the rest of our lives on this island. In the back of the plane, his husband turns to his wife and says, "Quick, you made a pledge to the university. Did you sign any documents?" And she goes, "No." Ha! He laughs. He starts laughing. He says, and the hospital, you're going to take the lead on the campaign. Did you tell the hospital a dollar amount? She says, "No." Ha! He starts laughing. And the church, the temple, the mosque, the synagogue, you're going to make a big gift. Did you pay them yet? No. Ha! He laughs. She looks at him. "Why are you laughing?" He says, "They'll find us." And so that's what happened with my university. So what if on September 30th, if I die in 2020, and I name my university as the 1% beneficiary, I have 3 children, each of them gets 33%, the charity gets 1%, 100%. The required distributions, if there is even just one non-human being on the determination date, on September 30 after your death, here's the old law. The old law is that by having that charity get 1%, I got to liquidate the account in 5 years. At the end of the 5th year, the account has to be empty. Now, if I die after age 72, then instead of 5 years, you have the remaining life expectancy of someone who is the decedent's age of death, 76-year-old example. Now, here's one time the Roth IRA rules are different than the traditional retirement plan account. There is no ghost life expectancy payout with a Roth IRA. Either way, you liquidate the account in 5 years, or there's a 50% penalty. So there's 3 ways to get rid of the university by September 30th. Now, the first way to get rid of a beneficiary is a disclaimer. The beneficiary says, "I don't want it." So somebody says, "Let the young people have it." That's a disclaimer. We all know disclaimers. The second is what we do with charities. We pay them off. Charities don't need deferral for 10 years. Charities are tax exempt. You can just give them the amount, they'll use the whole amount. So I should cash out the charity. The third thing we want to do before September 30th is divide it into separate accounts. For example, suppose instead of daughter and charity, it's daughter and sister. And the sister is within 10 years of age of the decedent, but the daughter is more than 10 years younger. Let me split the account, and now the sister can take it out of her life expectancy because she's within 10 years of age. The daughter can take it out of 10 years. So when one beneficiary is an EDB and another is not. And then my example of charity. Somehow, if we can't pay the charity by September 30th, just divide it into sub-accounts so the children can get 10 years, and then I can pay the charity out in 5. So that's the rule. If there's one beneficiary on September 30th, the year after death, that's not a human being. Again, if the 5-year rule kicks in, there's no required distributions until year number 5. But if I use the longer 14-year period in my example, each year has a required distribution. And this is what we call the ghost life expectancy. So here's the life expectancies of people who die in their 70s. At 74, it's 15.6 years. At age 80, it's 11 years. And what you do is you just divide that life expectancy by one. Sorry, one in the numerator divided by life expectancy. So in my example here of a 76-year-old, it's 1/14. Next year, 1/13, 1/12, 1/11, 1/10. Those are the minimum distributions you take over the 14 years. So those are the 4 time periods that the law kicks in. General rule, 10 years, 5 people get their life expectancy, but you might have to use the 5 years or the other rule. Now here's where it is. In the 13-page handout, the very last page has the new statute. And it's subparagraph H, special rules for certain defined contribution plans. You can see I highlighted that they changed the old 5-year rule to 10 years. And so the general rule now is 10 years. The problem with charities is the preamble you see there, except in the case of a beneficiary who is not a designated beneficiary. Well, charity is not a human being. The probate estate is not a human being. A trust is not a human being. We'll talk about trust in a minute. So in that case, the old law still applies when you have a beneficiary that's not a human being. The 5-year rule, the gross life expectancy rule continues to apply. And that's the last page of the 13-page handout. And that's how we're interpreting it. Again, we expect regulations, probably expect guidance, at least some notice from the IRS soon, but that's the rule we have now. So if on September 30th, the year after death, you've got a charity or a charitable trust as the beneficiary, you don't have 10 years, you've got 5 years or the gross life expectancy. So what are the transition rules? What if you are the beneficiary of a retirement plan account for somebody who died before 2020? These new rules apply for people who die after December 31st, 2019. For decedents who died before 2020, beneficiaries like you and me who inherited retirement plan accounts can continue to receive these payments over our life expectancy. But upon the death of someone who has an inherited account that's under these grandfather rules, the 10-year clock starts ticking. Let me show you an example. A 60-year-old inherited an IRA in 2019 when he had a life expectancy to age 85. Half of the 60-year-olds die before age 85, half die after. 25 years. But that individual dies 2 years later, age 62. So now it goes to the next in line. And the inherited IRA must be emptied the 10th year after death, rather than the year that the individual would have been age 85. So under the old rules, if the beneficiary dies and goes to successors, they used to have the remaining life expectancy of that person to age 85, what they would have been 85. Now it's just 10 years. So to understand all these rules, let's go back to the rules before 2020 and then just see how they changed for people who died in 2020. Again, under the old rules, it was really easy to tell the kids, children, you're going to inherit your parents' retirement plan account. You can take it out over your life expectancy. And they think, oh, I can take it out for the rest of my life. No, you take it out over your life expectancy, which is a table where half of the people die before a certain age, half die after. So here's the old life expectancy tables. And suppose I have 3 IRAs. One's payable to a 30-year-old granddaughter. One's payable to a 60-year-old son. And one's payable to an 80-year-old sibling. The old rule was real simple. The 30-year-old granddaughter could take it out to age 83 for 53 more years. 53 years of tax deferral. The 60-year-old had a life expectancy of to age 85. The 60-year-old could take it out for 25 years. And the 80-year-old could take it out for 11 years. And so what you did was you took that remaining life expectancy and put it in the denominator of a fraction, so that the 30-year-old only had to take out 2%. The 60-year-old only had to take out 4%. The 80-year-old had to take out about 9%. So the old law favored naming young beneficiaries. It didn't matter that the senior citizen was taking out 5, 9, 10% while they're alive. The payments dropped to between 2 and 4% for people who died before age, who have beneficiaries under the age 60. Well, the new rule is the 80-year-old has more time than the 30-year-old and 60-year-old. When you name the 60-year-old or a 30-year-old, the 10-year rule applies. Notice if you name a 70-year-old as a beneficiary, that person is within 10 years of age of the individual who died at age 80. And so they would have a 19-year payout. But we'd have distributions every year. One 18.7, one 17.7, one 16.7. And then the account would be empty in 19 years. So what's your strategy with this new 10-year rule? I told you to wait until the 10th year, but that could push them in a higher tax bracket. And so what we might want to do is actually take some amounts out over the 10-year period to keep people in lower tax brackets. And another strategy is to go beyond our normal estate plan, which is to leave everything to the children, and then they're eventually going to leave things to their grandchildren, but actually name the grandchildren as beneficiaries of the account for some of it. So if you have somebody with 2 children and 4 grandchildren, and they've got $1 million in a retirement account, spread the income over not just 2 tax returns, but 6 tax returns. And grandparents like the idea of a legacy to their grandchildren. So with 6 beneficiaries over 10 years, you've got like 60 tax returns to distribute the income and keep people in lower tax brackets. They'll all be 10 years. The second idea is to do a lifetime Roth IRA conversion. Pay the tax now if you think your current income tax rates are going to be lower than future tax rates. So it's hard to speculate on future tax rates. But I can tell you 2, and maybe in South Dakota 3, times where you can be pretty sure that future tax rates will be higher. The first is if you're going to leave a retirement plan account to a trust. A trust has the worst income tax rates. They pay a 37% rate with just $13,000 of income. So that retirement plan account is going to be payable to a trust. Maybe while they're alive, pay a 22% rate or 24% rate, especially in South Dakota, which has no state income tax, before it goes into the trust. The second is if a person's married. I have 4 grandparents. I had 4 grandparents. You did too, or do too. And 2 of my grandparents were widow and widower for 24 years each. And they went from joint rates to single rates. And so I've done Roth IRA conversions for myself and my spouse. We'll see who survives, who doesn't. But if it's like my grandparents, we locked in the low tax rates with Roth conversions. The third one is if you have a client who right now is in South Dakota and they're going to move to Minnesota to be with their children, they're going to move from a state that has no income tax to a state with this horrendous income tax, it might make sense to do the Roth conversion and pay only the federal tax in South Dakota. The third planning strategy is if you have any of these beneficiaries who are eligible designated beneficiaries. They will get the inheritance over more than 10 years. So when you have 2 beneficiaries and one's an EDB and one's not, do steps to protect the longer payout period for the EDB. Have a separate share for them by September 30th of the determination date so they can take it out over their life expectancy. The beneficiary gets 10 years. And then the idea of leaving this money to charity. When the charity gets the distribution, they pay no income tax. They can use all the money for charitable purposes, including the amount that would have been spent on federal taxes. And then we're going to spend a fair amount of time after the break on charitable remainder trust, leaving it to another tax-exempt trust. So, IRAs payable to trust. There's a lot to cover here, and I said we take a break at 9:40. Why don't we take a break now, and we'll come back at 9:45 and start doing planning with IRAs payable to trust. So let's take a 10-minute break, and we can pause the recording, and then let's come back at 9:45, and we'll start with IRAs payable to trust. See you then. Account goes to my sister, who's 62. In the event she dies, it goes to her kids, who are in their 30s. If you name the kids, there'd be a 10-year payout. But with a Conduit Trust, I can just say, look at the life expectancy of the sister who's within 10 years of age, and she can take it out of her life expectancy. I can ignore the nieces and nephews who are more than 10 years younger. With an accumulation trust where you have the power to retain or pay it out, I have to consider the nieces and nephews as potential beneficiaries. And now the sister has to take the money in just 10 years. And of course, if I accumulate it in the trust, I pay a 37% tax rate. But the effect of these remainder beneficiaries is, except for a mere potential successor, all beneficiaries are considered, and now the sister's got to get the money in just 10 years. So that's the potential negative impact when some trust beneficiaries are EDBs, the sister who's less than 10 years younger, and others are not, the nieces and nephews, the descendants of the sister, who are more than 10 years younger. So a lot of trusts were drafted under the old rules, and just a quick checklist of what if you have an IRA payable to a minimum RMD trust? Now what's that? It was pretty common until the new rules were enacted to say that in the trust instrument, take out only the minimum amount required by law. And remember, with that 30-year-old beneficiary, IRA is payable to a trust for that 30-year-old beneficiary, take out only 2%. Okay, I'll take out 2%. And in the IRA, it's earning 7%. The amount that stays in the IRA can grow and grow and grow because the trustee only takes out the minimum 2% to give to the 30-year-old. Well, with this new regime, that IRAs are liquidated in 10 years, and the minimum distribution is 0 until year number 10. If you have an IRA payable to that trust, the trustee takes out no money until the 10th year to take out 100%. So we're going to look at that minimum RMD, and you might want to change that language. Second question is whether the IRA itself is a trustee IRA. Now, if you have a mutual fund, it's a custodial account. But if you have your IRA with a trust company, First National Trust Company, First National Bank, it's a trust, then the IRA itself, it can be a trust at that institution. And the trustee can do the fiduciary duties of the IRA that they do with other trusts. And a lot of these trust companies have this box that said pay out the minimum required by law. And so Merrill Lynch, US Trust, Northern Trust, Key Bank had this option that if you had your IRA with them, you check that box, you paid out the minimum required by law. Well, now the minimum required by law is 0 in years 1 through 10. So trustee IRAs, they know what's going on, they're modifying the trust document. And then what if it's payable to a Conduit Trust, or what if it's payable to accumulation trust? So if you have a trust drafted before 2020, you might, and it has instructions about retirement plan accounts, you might want to review the trust instrument. If it says distribute only the minimum RMD required by law, there's no distributions in years 1 through 9 after death, and that's all in year 10, pushes you in a higher tax bracket. So consider modifying the trust, consider decanting to a new trust instrument if you have to. And even if they're dead and the trust is irrevocable, most states, and South Dakota's got great state laws for trusts, most states will allow you to modify the trust terms if tax laws change to accomplish the tax objectives that the person who settled the trust had. We then say, well, what if I have a conduit trust? And we say, what's the point of it anymore? Unless the beneficiary is an eligible beneficiary, all distributions of trust will be paid out to the beneficiary in 10 years anyway. By the end of the 10 years, they're going to have all the money anyway. Is it really worth having a conduit trust be the beneficiary? But one exception here is if the beneficiary is an EDB who has a life expectancy of like 30 years. Well, now we can have asset protection, professional management, and things like that for 30 years. Also with accumulation trust, the trust will pay the highest 37% tax rate if they take the distribution. And what if the beneficiaries are in a much lower tax bracket? But there was one question about, I think it goes back to the people working after age 70 and a half, and they want to have their IRAs qualify for charitable gifts. You know that if your income is over a certain threshold, you can put money in an IRA, you can put $7,000 in, but there's no tax deduction, a non-deductible IRA contribution. That will not be a problem. This law on qualified charitable distributions from IRAs only applies to people who deducted the $6,000 or $7,000 they put into the IRA. So if you're working and you make a non-deductible contribution to an IRA, which is what you can do if your income is too high and you have a plan at work, that won't be a problem for charitable distributions. I think that's what the question was intended for. Bottom line though, if you are going to accumulate the money in the trust and pay a 37% tax rate, will the benefits of the trust outweigh the higher income tax costs? And the benefits of a trust, especially with a trust company in South Dakota, are asset protection, professional management, and then for spendthrift beneficiaries to protect them from themselves of being spendthrifts. So in general, South Dakota's got great trust companies, and you're famous for it. But do we need a trust? Because there's administrative costs. And when I talk to Kansas City attorneys, they say, if the children are financially stable and there's not that much money, the person dies with $1 million or so, and each child's going to get a third of $1 million, there's probably no need for a trust. We start looking at trusts when each child's going to inherit like $1 million or more, we might want to have that protection. But if you're going to have a trust in general, and you got retirement plan accounts, you got to plan for this 37% tax rate, because other assets get a step up in basis, but retirement plan accounts do not. And the children will be in a lower tax bracket unless they have income over $500,000. So there's 3 ways to have an IRA payable to a trust where you will not pay the 37% tax rate, but instead you will pay the tax rate of the beneficiary. The third one we'll spend some time on in a few minutes, which is a charitable remainder trust. But the other 2 trusts are called a twin teapot trust and a BDOT trust. So CRT, teapot trust, BDOT trust. Let me show you what they are. So the twin teapot trust is from Alan Gassman, the Florida attorney in St. Petersburg. And so he's come up with this device where we will pay the lowest income tax rate possible when an IRA is payable to a trust. And basically the concept is somebody dies with stock and real estate, gets a step up in basis, no income tax when they inherit it. And they also have retirement plan accounts that have taxable income. So the concept is if an estate has both taxable IRD assets and tax-free assets, then the greatest amount of wealth will be transferred to the heirs and beneficiaries if the income is taxed at the lowest possible tax rate. So what we do is we have children who are in different tax brackets. And to make it dramatic, I'll have one child in South Dakota who is a school teacher, and you have no state income tax. And another child who lives in Minnesota, which has a high income tax rate, and they're an anesthesiologist. They're paying 50% or higher on their income in Minnesota, and the one in South Dakota is paying 20%. So we have a pot trust named as a beneficiary of the retirement account. We have another trust that has a stock in the real estate. So pot trust is named as beneficiary. The trustee can give more or less to any beneficiary. Well, lo and behold, the IRA is payable to the pot trust, and it's all going to go to the child in South Dakota. And the child in South Dakota is an accumulation trust, and so we pay the IRA the distribution that year, and it all goes to the child in South Dakota. And then we say, child in South Dakota, how much income tax did you pay on the $100,000? $100,000 comes from the IRA to the trust. You pay it out to the child in South Dakota, the $100,000 of income. The child in South Dakota said, I paid $22,000. Okay. And now we go to the other trust, and we say, and basically by paying $22,000 in income tax, the child has $78,000 left over. We go to the other trust as a step on basis assets, we give $78,000 to the child in Minnesota. And that way, we pay the lowest possible tax rate on the inherited retirement plan account. So the separate pot trust will distribute tax-free principal to the high tax rate beneficiary. And basically each child got $78,000 after taxes. Now there's 2 challenges you have to worry about with this twin teapot trust system. The first is the IRS has the power to merge the 2 trusts. and basically saying, no, some of that went to the child in Minnesota. And so they have articles, the Gassman Law Firm has articles on this. But you got to avoid the merger of two trusts. Or the simplest way, for example, is that no distributions take place to the child in Minnesota until year number 11, until after 10 years of IRA distributions, we figured out the tax. The second problem we have is just the problem with any discretionary trust, where one child says you're favoring one person over the other. Child South Dakota says, how come I'm paying all the income taxes? Let's just split the IRAs, let them deal with it. They chose to live in Minnesota, and let them cope with these kinds of issues. The second kind of trust where we would avoid the 37% tax rate is the BDOT, the Beneficiary Deemed Owner Trust. And a BDOT is a grantor trust where the income of the trust isn't taxed to the grantor is dead. It's taxed to the beneficiary under Code Section 678A, and the beneficiary will be in a lower tax rate than the 37% rate that a trust pays. The trust distributes enough cash to the beneficiary to pay the income tax at their normal rate. Now, to be a grantor trust, the beneficiary has to have a withdrawal power, not over everything in the trust, just the income of the trust. And that leaves the principal in the trust protected from creditors. So no withdrawal power is given over principal. This provides asset protection. So if we have $100,000, we distribute $2,000 to beneficiary, we keep $78,000 in the trust, and now that's reinvested as principal with asset protection for professional management and the like. So since an inherited retirement account is nothing but taxable income, a BDOT is a technique to really lower the tax rate from 37 to 22 or whatever rate it's going to be. That said, it's not a cure-all. You wouldn't want to have withdrawal power if the beneficiary has substance abuse issues. That's why you set up the trust, was to protect them from themselves. Also, if you're trying to qualify for Medicaid, you don't want that power of withdrawal that would disqualify them for a Medicaid trust. So in that case, we want an accumulation trust, and we're stuck with a 37% tax rate. A great article on this topic is from an attorney in Cincinnati, Ed Morrow. He's with U.S. Trust Company. He wrote an article with the law in all 50 states, and you can get it for free. Download the PDF. Just do a Google search with 8 letters, SSRN space BDOT. SSRN is a social science research network, and you can get the article at no charge. But let's do a little bit of planning, of just basic planning of protecting those eligible beneficiaries for the longer payout period. And we don't want them to be subject to a 10-year rule if they could have had more time. So the spouse, the minor child, the disabled person, the chronically ill, and a person not more than 10 years younger. And we said earlier, if I have an accumulation trust, which says the trustee has the power to accumulate retirement plan distributions to the trust, take care of my sister for life, she's less than 10 years younger, she's an EDB. And if she dies, it goes to her descendants, my nieces and nephews, her children. So if you have an accumulation trust for the sister, a spouse, like a keeping trust, a minor child, and you also have beneficiaries that are not EDBs, does that mean we have to liquidate the trust in 10 years? And generally, yes. We're speculating based on current regulations. That sister can't take it out over her life expectancy. Under current tax regulations of an accumulation trust, we'll consider all the beneficiaries, and we take it out over the fastest time period of just 10 years. So suppose we have an accumulation trust that says, in a second marriage, pay to my second wife for life, remainder of my kids from my first marriage. Well, the second wife is an EDB, she's a surviving spouse. The children from the first marriage are not. And right now, an IRA payable to a trust like that would have to be liquidated in 10 years. And even if she lives to be for 40 years, we liquidated it in 10 years, and the IRS collected all its taxes. So we consider alternatives, like a conduit trust for the surviving spouse, or a fraction of the IRA goes outright to the second wife, a fraction goes to the kids, something like that. Now, there is an exception where I can disregard the nieces and nephews. And that's if the sister is disabled or chronically ill. So if you have an IRA payable to a trust for a disabled or chronically ill individual, even though it is an accumulation trust, and even though I would normally consider the other beneficiaries, I can disregard the other beneficiaries. And this was something that was at the last minute lobbied for and got into the statute by NELA, the Organization for the Disabled. So this is this multi-beneficiary trust language. And again, it's in the last page of the 13-page handout. And you want that person to qualify for Medicare or Medicaid. The IRA can be payable to the accumulation trust, and we don't have to flow it out to the beneficiary. And we only look at the life expectancy of that disabled person to have the payouts. Now, that statute only provides exemption for trust beneficiaries who are disabled or chronically ill. If you have other EDBs, like a surviving spouse, a minor child, or someone within 10 years of age, then you might want to have a conduit trust for them, so they can take it out over 20 or 30 years and not be stuck with just taking it off over 10 years. So here's a case study. Let's go through a case study with a surviving spouse. Again, a conduit trust for EDB permits the minimum distribution to be over the EDB's life expectancy without considering the potential impact of contingent or remainder beneficiaries who are not EDBs. The conduit trust can still make sense for a surviving spouse, someone who's not more than 10 years younger, or a minor child, and again, at age 18, maybe you start having it be an accumulation trust. But I want to point out, here's a case study. A surviving spouse, a rollover is generally better. So here's a man who dies at age 93. His widow is age 80. Man's 93, widow's age 80, and the widow lives to be 94 years old. So here's a case study. D. John Mustard owned 3 IRAs when he died this year at age 93. The surviving spouse, Honey Mustard, turned age 80 the year after his death. Now, each of the 3 IRAs has a different beneficiary. IRA number 1 is payable to an accumulation trust for Honey. If the distributions come in, the trustee can accumulate it or it can distribute it to Honey. The remainder goes to his kids from a prior marriage. IRA number 2 is payable to a conduit trust for Honey. As every check comes in, it must be distributed to Honey. The remainder in that trust to children from a first marriage. IRA number 3 is just payable to Honey. She's the sole beneficiary, and a rollover is possible. For that first trust, I got to consider all the beneficiaries. And even though Honey is an EDB, the fact that I've added the children from the first marriage means that we default to the 10-year rule. So for IRA number 1, there's no distributions in years 1 through 9. But at the end of the year 10, we got to liquidate the account. Notice that Honey lives until age 94, but we'll have paid all the taxes on the distributions because the account had to be liquidated the year Honey attained age 90. Now with a conduit trust, I get 2 tax breaks. The first one is I can ignore the beneficiaries, the kids from the first marriage. With a conduit trust with any beneficiary, I can focus only on that primary beneficiary. So a conduit trust with several beneficiaries permits an EDB to receive distributions over the remaining life expectancy rather than just 10 years. Though I'll have to take a minimum amount every year by taking that ratio of their life expectancy divided by their life expectancy. The second break applies to Honey because she is a surviving spouse. And with a surviving spouse, she can recompute her life expectancy. So normally with an 80-year-old, I would have to liquidate the account over 11 years, as opposed to 10 years. But because she's a surviving spouse, I can keep on recomputing her life expectancy. So With the Conduit Trust, there will be minimum distributions every year. At age 80, it'll be 111. Next year, it'll be 110, and 1/9, 1/8, 1/7. But because she's a widow, a surviving spouse, I can recompute these amounts and say, well, at age 90, it looks like she died at 100, whatever, just and make these changes. So that's IRA number 2. IRA number 3 is the rollover, where now it's her IRA. And just looking at the best 2 options, the problem with having a trust for surviving spouse is you double the required distributions when they get elderly. Instead of taking out about 5%, you got to take out 9%. At age 90, instead of taking out 8%, you got to take out 17%. So the rollover is normally the way to go. And so the 2 times you might want to not do it is for younger, somebody under age 59 and a half, and then the disparity in age. The rollover is going to be normally the best option. But you might have a spouse who's physically or mentally unable to handle money, and I've got to have it paid to a trust. At least with the Conduit Trust, you can recompute the life expectancy. So the rollover is mathematically better for income tax purposes than having it payable to a trust. So to wrap up, you have the IRA payable to minimum trust, trustee IRA and the like. If you're having payouts way too fast, consider modifying the trust instrument to accomplish what you want to accomplish. Now, charitable mandate trust and trust. First of all, people might decide to leave some of their retirement accounts to charity because it's all that pre-tax income. The kids that have income tax, the trust pay a higher rate. I have 3 children. I set up donor advised funds for each of my children. And in one of my IRAs, I have a portion of it going to their donor advised funds. I'm leaving it to charity and family at the same time. Now, with this lifetime IRA gift, you can't put it into you can't take money while you're alive over age 72 and put it into your own donor advised fund and have it qualify for the qualified charitable distribution. But there's no problem with inheriting a distribution from an IRA. So I have one of my IRAs payable, a fraction that's payable to the IRAs of my children. They can start with small balances now and know that a larger balance will come in upon my passing. And my income that I earn will never be hit with income taxes. So you can leave it outright to charity. You can leave it to charity and family through philanthropy, leaving it to donor advised funds. But everyone watching this program in South Dakota, you can go to your clients and you can say, you know that new law that says you got to liquidate inherited accounts in 10 years? Yeah, I know about it. How would you like it if your kids could get that money out for the rest of their life? Well, I like that, but the law says 10 years. So I can do that for you. I can have a steady stream of income, not for their life expectancy, for their actual life. If the kids live to be 110, they'll have income for life. How do you do that? Well, that's the charitable remainder trust. We have $1 million in IRA, and it's going to go to charity. But before it does, it goes to this trust. And then for the life of your child, we pay an income stream to the child. And then when your child dies, then the $1 million goes to charity. And the secret sauce in this is that the charitable remainder trust is tax exempt. And so the $1 million leaves the world of IRAs, goes to the charitable remainder trust. The charitable remainder trust has $1 million of income, doesn't matter, it's tax exempt. It's going to go to charity, but in the meantime, it pays income to your child. So your child can get the income over more than 10 years. Then it goes to charity. And what I'm looking at is having a charitable remainder trust that goes with income of a spouse for life. But then when my spouse dies, it doesn't go to charity, it goes then to my kids for life. And then when my last child dies, it goes to charity. There's no federal estate tax deduction when you have spouse, kids, charity, but I have less than $11 million. I was that close. I was that close. So as long as you don't have to worry about the federal estate tax, this is a great income tax tool. So you all know charitable remainder trust. You have a payment to a non-charitable beneficiary for life, or if you want years, like 5, 10, 15, 20 years, you could do a term of years, maximum 20. Remainder interest goes to charity. The secret sauce, though, is it's tax exempt. And when the $1 million leaves one tax exempt trust, the retirement account, it goes to another tax exempt trust, the charitable remainder trust, and the charitable remainder trust keeps all $1 million to invest. And then what I was talking about earlier is the two-generation charitable trust. Paid 5% to my spouse for life. Then when my spouse dies, it goes to my kids for life, and then it goes to charity. And it's kind of like a Q-tip trust for taxable income. We'll talk about second marriages in a few minutes, but a Q-tip trust says take care of my second spouse for life, remaining kids for the first marriage. That's cool for stock and real estate, but it's a problem for the retirement plan account because there's a 37% tax rate. So you have a retirement plan account go to a charitable trust, have the tax-free assets step on basis in the traditional trust. The CRT then gets retirement assets, take care of my second married spouse for life, remaining kids from the first marriage for life. So that's the other planning option for this new tax law of the 10-year liquidation, is have it liquidated over the life of your children rather than just in 10 years. So the theory is tax deferral. Move income in respect of decedent, stuff that would have been taxable to my kids, move it tax-free from one tax-exempt trust, the IRA, to another tax-exempt trust, the charitable trust. Now you're probably hearing about how this low interest rate environment is great for charitable lead trusts. And charitable lead trusts are wealth transfer techniques. Charitable lead trusts are horrible for IRAs. They are not tax exempt. So don't name a charitable lead trust as an IRA beneficiary. You're going to be paying 37% right away and have a lot of shrinkage. There's several private letter rulings on this, and the most thorough is private letter ruling 1999-01-023. It said the beneficiaries will not have taxable income until they receive those distributions from the charitable remainder trust. So no taxable income to beneficiaries until they receive distributions from the CRT. So the question is, if you're not charitable, should you do this with your retirement plan account? Can a charitable trust produce more family wealth than a 10-year liquidation? On its face, it shouldn't, because with a charitable remainder trust, by law, when money goes into a trust, at least 10% has to go to charity. No more than 90% can go to family. Versus if I leave the IRA to family, 100% goes to family. But I'm going to run through a pretty basic example in a minute that shows how you can have more money for the family with a charitable trust. That said, we've had problems where people who are not charitable inclined try to use a charitable trust as a gimmick to benefit the family, and then they get upset that the outcome wasn't what they wanted. What you really want are clients who are charitably inclined, and then they should go pretty well. They have ideas of how the charity should spend the money when they get the $1 million. So, yes, it is possible to have more wealth for the family with a charitable trust, but usually it's not likely. And it can happen when you have two things where the charitable trust produces more wealth for the family. Number one, high tax rates, and number two, long-term charitable trusts that last for 30, 40, or 50 years. The outcomes vary with the investment returns, with the tax rates, and the like. So let me give you a very, very basic example of how the charitable trust will produce more wealth for the family than a conventional plan. I'm going to pretend, to make math simple, that everybody earns 5% on every investment. Every investment's earning 5%, no more, no less. And we have this family, and this family is from Aesop's Fables. This is the grasshopper family. If you remember the Aesop fable, the grasshopper and the grasshopper fiddled away the summer, and the ant was thrifty and saving, and then when the winter came, the grasshopper perished, and the ant was able to survive. So this is the grasshopper family, and the grasshopper mom and dad are looking at the grasshopper child and say, we have $1 million IRA. If when we die, that child gets the money, we're going to splurge it all. So we're going to leave the $1 million IRA to a spendthrift trust, and that will take care of a child, so there will always be assets for a child. Now, when it goes to the spendthrift trust, you pay a 37% tax rate, and it's rounded to 40% to make math simple. So the trust pays $400,000 of income tax, but now the trust has $600,000. and the grasshopper will have investment income of $600,000 for the rest of the grasshopper's life. And there'll be money left for the grasshopper's descendants because the trust company will manage it well. The other family is the ant family. They also have $1 million IRA, but they're going to leave it to a charitable remainder trust for their child, the ant. And so the $1 million goes in the CRT. Eventually, it's going to go to charity, but until it does, it's going to provide an income stream to the ant for the rest of the ant's life. Now, at death of the ant, the charity gets the whole $1 million because the charitable trust won't pay the income tax. On the death of the grasshopper, the family's got $600,000 for the descendants of the grasshopper. So one thing we see is that the ant will have more income than the grasshopper, because if you invest at 5% $1 million, you'll have $50,000 a year. If the spendthrift trust invests at 5% a year, it'll be $30,000 a year. Now all of a sudden the ant is feeling a little bit guilty because the ant says, you know, it's nice to have this extra income, but when I die, my children won't get anything. When the grasshopper dies, the children will get the $30,000 a year from the spendthrift trust. So I would like to take care of my kids. I would like them to get the same inheritance that the grasshopper grandchildren are getting. So what I'm going to do is I'm going to not spend all $50,000 I get. I will have the same lifestyle as the grasshopper. Of the $50,000 of income, I will spend 30. The grasshopper's spending 30, but I will save the extra $20,000. And that's the bottom line. Will the extra income you get from a charitable trust, income produced by the income taxes you don't pay at $400,000, will that extra income over time produce enough wealth to replace the fact that the descendants of the ant don't get $600,000? Well, that $20,000 is taxable, so the ant has to pay income tax on it. I have here a ridiculously high tax rate of 40%, and it'll probably pay a lot less. So there'll be $12,000 a year to invest to save for the ant's descendants. The question is, how long does it take for that $12,000 a year to equate the $600,000 that's in the trust for the grasshopper? If you get 0% interest, it takes 50 years. If you get 5% interest, it takes about 30. So there you have it. If the trust lasts for at least 30 years, and if the ant is in a 40% tax bracket, you'd have the equivalent in just 30 years. And rather than just save $12,000 a year, the smart thing to do is to buy some life insurance. Get a $600,000 policy, because what happens if the ant dies just a year or two into this, the whole plan disappears. So use the after-tax cash to buy some life insurance, and then you can be assured that the ant's descendants will be in the same economic position or better than the grasshopper's descendants. So that's what you have if you have a high tax rate and a long term. Change the tax rate. Suppose we have a child in South Dakota who's just in the 20% federal tax bracket. And we don't just distribute $1 million in 1 year, we distribute over 10 years. And the child gets like $100,000 a year and pays a 20% tax rate. So now the child has $800,000 accumulated, versus we could have $1 million go to charitable trust. And now we see that there's not that much extra income from the tax savings of having $200,000 of income tax that's avoided for the charitable trust. And so if we try to do the same thing, we spend $40,000 but save 10, well, how many years does it take for $8,000 to go to 800? It's not going to work. So with low tax rates or short terms, you're definitely not going to have more money with a charitable trust than outright. So outcomes vary with investment returns and tax rates. And if you just, all right, this one's high tax rates, this one's long term. Charitable trust makes a lot of sense. This is low tax rates. We're not going to save that much. Also, when I look at projections that were made 30, 40, 50 years ago, how many times have they ever come to pass? Never do. And so basically, a charitable trust is best for somebody who has charitable intentions. who has visions of how they want the money spent um, when uh, when when their children die, and how $1,000,000 will be spent. So I have a quick checklist on CRTs as a beneficiary of term fund accounts. And I'm going to run through these pretty fast because we want to get to marital issues in a minute. Picking the right trustee and charity. I want a charity that's going to be around when my kids die. So I need a stable charity, like the Kidney Foundation, great university. I probably want a corporate trustee. I want a trustee who can administer a CRT, make the distributions, and how much money do I have to justify that? Some charities are willing to do it with $100,000, like Harvard University and Washington University, but I think we're talking like, $250,000, $500,000. See what your policy is in South Dakota. I'm going to rush through this. I like a charitable and a unit trust as opposed to a CRAP for life. What I want to warn you about is there's a tax trap. You can't name young grandchildren as beneficiaries of a CRT. And the hassles you got to deal with is the CRT has to have payouts of between 5 and 50%. If you want a unit trust that pays out 4%, you can't do that. A charitable trust has to have at least a 5% payout. So that's the lowest we can do. Also, you need at least a 10% charitable deduction. It looks like it's in French, a déduction. For the rest of this lecture, I was taught with a French accent to have a 10% charitable déduction. In fact, you want to hear a Switzerland joke? Switzerland joke. Question: what are the advantages of living in Switzerland? Answer: I'm not sure, but the flag is a big plus. I just love it. Okay, it's a visual joke. You need a 10% charitable deduction, which means at least 10% of the value of property you expect to go to charity, and no more than 90% of the property goes to the family. And oversimplified, there's two ways to have the charitable deduction, or déduction, be less than 10%. The first is having a ridiculously high payout. Pay 80% of the assets to my kids every year. There's nothing going to be left. But the second way is if the term of the trust is too long. This is the problem with naming grandchildren as beneficiaries of CRTs. This law basically limits the projected life of the charitable trust to 55 years. What does this mean? It means if I want to have $100 in 55 years, how much would I have to invest now? To have $100 in 55 years, you have to invest $10 now, 10%. What if I want to get $100 in 70 years or 80 years? Well, it takes less than $10. And that means if you want to have a charitable trust last for 70 years, you will fail the 10% deduction requirement. I have here on the screen two numbers, 27 and 38. Looks like a football call. But basically, in 2019, last year, when we had a 2% interest rate, if there was only one beneficiary of a charitable remainder unit trust, then the 10% test was not only if the beneficiary was at least age 27. If there are two beneficiaries, like you have twin children or two spouses, and you say, I want to have a trust that terminates when the last of the two dies, each had to be 38 years old. So if you have multiple beneficiaries who are young, you might have to have a separate charitable trust for each one. Another might be a term of year CRT. And I'm just not going to go, I'm going to run out of time for the term of year CRT. I'll just scribble through this, but I'll just say the sweet spot for me is a 5% charitable unit trust that I think will last for at least 30 years. Because the trustee, number one, can earn more than 5%. It can earn 7%, and then the trust can grow. And so I get the benefit of the family. I get basically a really great outcome for a long-term trust, especially if it's close to the 55-year projection. There's a bunch of other technical requirements. They're in the outline that you have there. So I'll just skip through all this stuff to get to the topic that's pretty important for you: retirement accounts in second marriages. How do you know if you're married? I think of the words 100 years ago. I think it was H.L. Mencken who said it. A man may be a fool and not know it, but not if he's married. Okay, then you know. So we're going to look at the laws that apply mainly to employer plans, pension, profit sharing, and 401k plans, and individual retirement accounts. If you've got these other 450 annuities, 457B, you have to do some research. And the typical situation is you're going through some estate planning, and let's say my husband has those IRAs and 401ks, my wife has these IRAs and 401ks, and they treat them the same as retirement plan accounts. And in some ways they're right. In some ways they're right because they have four things in common. First, they defer income tax. When you're working, you put money into a retirement plan account, and you don't pay tax until you take the money out. Second, they all have a 10% penalty. If you get a distribution that's taxable before you're 59.5, you also pay 10% surtax. Third, they all have these minimum distributions after you're age 72, where there's a 50% penalty. And fourth, they're all taxed as ordinary income, and they're not hit with that 3.8% surtax on investment income. If your income's over $200,000, there's a surtax on interest, dividends, and capital gains. Retirement plan distributions are exempt from that. So they have a lot of things in common. But there are differences. And the differences arise based on who has the money. If you're at work and you say, you know, I want to save for retirement, take $1,000 out of my paycheck and put it at my retirement plan account here at work. Your employer has your money. And so Congress said you need protections, because what if you work for J.C. Penney, Lord & Taylor, Briggs & Stratton? All of them filed bankruptcy this year. And so you need protections that your $1,000 are protected from the employer's creditors. You need protections that the $1,000 is protected from your own creditors. And so they enacted a law called ERISA, E-R-I-S-A, in 1974. Some people think it stands for the Employee Retirement Income Security Act of 1974. Those of you who worked with it have referred to it as by other terms like every rotten idea since Adam, or my favorite, Elvis really is still alive. So those laws protect you and from the creditors of your company and the creditors of your own creditors. By comparison, with an individual retirement account, it gets the word individual. You go to First National Bank in Sioux Falls, and you set up an IRA with them. You don't need this kind of protection of your employer going bankrupt. Yeah, there were problems in 2007, but with financial institutions that are regulated, you don't need all these kinds of ERISA protections. So Congress determined basically that the bottom line for the rest of this program is that your rights with your 401k plan are determined almost entirely by federal law. You look to federal law to learn what are your rights with your 401k plan. By comparison, your rights to your IRA are governed by South Dakota law. South Dakota state law determines your rights to your IRA. So some examples are your ability to get your money out of your retirement plan account while it's still working. Suppose last year you put $1,000 into your own retirement plan account, 2019. This year, 2020, you say, you know, I need the $1,000. So you go to your employee benefits office and say, that $1,000 of my money that I put in your retirement plan account, I need it, give it to me. They will say, we cannot give you your $1,000 back. Say, why not? They say, well, your 401k plan is a retirement plan, and you're still working for us. And federal law prohibits us from giving you back your $1,000. So you generally have no right to get your money back until you terminate employment. Now there's three ways to get the money out while you're still employed. The first is a loan. You can borrow your $1,000, but you got to pay it back. The second is a hardship distribution. And again, we said how if this year someone in your family has COVID, that's an automatic hardship distribution eligibility criteria. But you have to show a financial emergency. The third way is that we are allowed to pay the money to you if you're still employed over the age of 59.5. And then we can still pay it to you. And that'll be in the plan document, loans, and distributions, and 59.5. But short of that, you have to quit your job to get your $1,000. Now, if you put your money at First National Bank, your $1,000 IRA, and you say, I need my $1,000 back, you'll get it. There is no law stopping you from taking your money out of your IRA. Now, there's a 10% penalty if you're not 59.5. But there's our first example of the difference of just your right to get your $1,000 back is different under federal law with a 401k plan than with your IRA. Another difference is how accounts are split and taxed at divorce. If there's an employer plan, a 401k plan, for example, you need what's called a QDRO, a Qualified Domestic Relations Order. The family court can't just issue any old court order to get the money out of the 401k plan. They have to issue a special Qualified Domestic Relations Order. The federal statute says it has to list certain things like names and addresses, and cannot do other things, or cannot require an annuity or things like that. Here's the statute, and this applies to all of you who have a plan at work, whether it's a law firm, accounting firm, a trust company, a bank. Your money in your retirement account at that employer is protected from creditors. You can see in yellow, you cannot assign your retirement account to somebody else. It cannot be seized by creditors. And then there's a special rule, subparagraph B, for family court orders, domestic relations orders. Your account is protected from a divorce court order. Subparagraph A shall apply to the creation, assignment, or recognition of a right to any benefit payable with respect to participation pursuant to a domestic relations order, except that subparagraph A shall not apply if the order is determined to be a qualified domestic relations order. So with large employers, if there's a divorce, the large employer, Verizon, McDonald's, Coca-Cola, they'll say, all right, here's the form we use for QDRO, here's the court order you have to state. That's with a 401k plan. With an IRA, any court order is split to IRAs. It doesn't have to be a qualified domestic relations order. There's no QDRO for an IRA in divorce. And here's the statute 408B6. It just says when a court splits an IRA and retitles a portion of the worker's IRA or your IRA or someone's IRA, when they split the IRA, that's not a tax distribution. But from this date forward, it is that other person's IRA for that fraction. So if we have a distribution from a 401k plan to an ex-spouse, that's taxable income, and there's no 10% penalty for the distribution. And here's the statute, and I call it 10% penalty because it's easier to say. Technically, it's an additional tax. And now this gets to how we draft statutes. We can draft statutes like we do in France. In France, anything goes, except for these things that we make illegal, compared to how we draft statutes in Russia. In Russia, everything's prohibited, except for these things that we permit you to do. This is a Russian statute. This statute says that every taxable distribution has a 10% penalty, except for these distributions that will not have a 10% penalty. And that is a dangerous thing, as you're going to see with IRAs. So here it is. It's 10% test, and this tax applies to IRAs, 402Bs, 457B, and 401k. Imposition of additional tax. If any taxpayer receives any amount from a qualified retirement plan that's taxable, it shall be increased. The tax shall be increased by an amount equal to 10% of the portion which is including gross income. Tax-free stuff is not hit with a penalty, only the taxable income. Then here are the exceptions. Subsection not to apply to certain distributions. And the first one we see is after you attain the age of 59.5, there's no more 10% penalty. So that's how this 10% penalty rule kicks in if you get a distribution under 59.5. The big one is the first exception. Then there's about 14 other exceptions where if you're under 59.5, you can get a distribution with no 10% penalty. Let me show you the one that's most important to estate planners. It's an inherited account made to a beneficiary or the estate after the death of the employee. So if a 40-year-old employee dies and a distribution is made to a 40-year-old beneficiary, or 20-year-old beneficiary, none of them were 59.5, but it's an inherited account. And so that's our first exception where you can be under the age of 59.5 and get a distribution free from the 10% penalty. Well, subparagraph C has the exception for QDROs with a divorce and a plan at work. Payments to alternate payees pursuant to qualified domestic relations orders, any distribution to an alternate payee pursuant to a qualified domestic relations order will be exempt from the 10% penalty. How does this relate to your planning for a married couple or a divorcing couple? A distribution from a QDRO is exempt from the 10% penalty, but the 10% penalty does apply to distribution received from an IRA that was split after divorce if the beneficiary is under the age of 59.5. Why? Because we got different statutes. Code section 408 applies to IRAs, and that subparagraph C only applies to QDROs, and QDROs do not apply to IRAs. So if you split an IRA in a divorce and somebody starts taking distributions out of the IRA, they get whacked with a 10% penalty. So there are differences in marriages between employer plans, which are governed by federal law, and IRAs that are basically governed by state law. IRAs are tax-exempt trusts, but your right to the money in the IRA is governed by mainly South Dakota law rather than federal tax law. So let's do some planning with married couples who have retirement assets. And now we recognize that when they've got IRAs and 401ks and so-and-so's got IRAs and 401ks, wait a minute, there are different rules that apply to them, and I need to do some planning for my married couple. First is the estate planning at death. Should we have the survivor do a rollover, or should this go to a trust? And my planning objective is different if there's a second marriage and there's children from the first marriage, because we got to deal then with a stepmother or stepfather, or as that person is often referred to, will the defendant please rise? You know, we're going to have lawsuits. Second, once I do my planning, is there a law that interferes my objectives, where I want to do one thing, but the federal law says something else is going to happen? So we talked earlier about how a surviving spouse has tax breaks that other people don't have. The surviving spouse can do a rollover of the deceased spouses into their own IRA. The kids can't do that. The kids just have to take the distributions out over 10 years, and the inherited IRA liquidated within 10 years. And let's just go back real quickly to the example we did earlier about Honey Mustard and her husband, Dijon Mustard, the French accent. You know, Conan O'Brien was talking about how you like the simple things in life. He says, I like to go to the bakery department of the grocery. I like to smell the bread. And then the simple things in life, I'll buy a baguette. I'll buy some French bread. And then what are the simple things in life? I'll take the French bread home, I'll put it next to the German bread, and I'll watch it surrender. And he just gets a little kick out of it. So we're doing planning for longevity. Here's statistics from federal state tax returns. The median age of death for men is age 80. The median age for women who filed state tax returns was age 84. 19% of the state tax returns are for people who died after age 90. You should expect that 1 out of 5 of your wealthy clients will live past age 90. About 40% are people who died in their 80s. And for men, 53% live past age 80. For women, 66% live past age 80. And when I show this, I'm not saying the men die at age 80, women die at age 84. I'm saying half the men live past age 80. Half of the women live past age 84. And we want to plan for longevity. And with retirement accounts, I want to keep the balance at $100,000 and not have it shrink to 60. So when I have it go to a trust, I go through the Dijon mustard and honey mustard. If I have the IRA payable to an accumulation trust, this goes to my wife, then my kids, or my second wife, and then my kids from the first marriage, I got to liquidate in 10 years. If it goes to a conduit trust, I got these payouts of 17%, 20%, versus the rollover is normally the way I want to go for older spouses. After age 80, I just double the payouts having it payable to a trust. And so we have a bunch of IRS rulings where typically man had an IRA payable to a trust for his wife, and she says, I don't want to go to a trust. I wanted to go to me and do a rollover. And we have these IRS private letter rulings where, yes, a trust was named as the beneficiary, but the IRS said the widow could do a rollover. And these took place, and this is in the handout for IRAs and second marriages, the list of some of these private letter rulings, where this went to a payable to trust for the surviving spouse, or it was payable to a probate estate that then poured over to a trust for the surviving spouse, or it was just payable to the spouse, the estate, and the spouse was benefiting from the estate. So these people had to pay for a private letter ruling. We're finding more and more trust companies are sophisticated about this, and that you can go to the IRA administrator and say, listen, go to the legal counsel of the IRA administrator. Listen, we got one of these deals where husband named a trust for the spouse. We'd like to do a rollover. Some trust companies say you got to get a private letter ruling. Otherwise, we're going to pay into that trust. But other trust companies more flexible. ACTEC is asking for a public ruling. Come on, make it clear, and don't make us pay for private letter rulings. But with a good legal counsel, you should be able to do the rollover if that's what you want to accomplish. Just before we take our break, what about an IRA in a second marriage? So I'm going to do a real dramatic example. I'm going to have a man who's going to die first, married to a woman who's going to die second. And the man has only one asset, a $4 million IRA. His second wife has no assets. Each of them has children from a prior marriage. So that's the estate plan we're doing. And this man who says, I'm going to die first, is looking at these payouts you see on the screen. Now, the best income tax outcome would be if I just give you a rollover. I will name you as the beneficiary of my $4 million IRA because you'll take out a lot less. The law will require you to take out a lot less than if I had to pay able to a trust for you. And then when you die, it goes to my kids from the first marriage. So if I have to go to an accumulation or conduit trust, then there's a chance the kids from the first marriage will get something. Of course, if she lives for more than 10 years with an accumulation trust, the IRA has been fully liquidated. But there's a chance the kids will get something. So the IRA is the way to go. And he says, what if I give all $4 million to you? How will you do the rollover IRA? She says, well, I'll fill out the forms. And as I fill out the forms, I will select the beneficiaries when I die. And then he says, well, how do I know that when you die, that you will name my kids from my first marriage as opposed to naming the children that you gave birth to? That's the problem. What assurance do you have that a child from the deceased spouse's prior marriage will have a chance at the IRA? When you do a rollover, you are giving legal control of those assets to the surviving spouse. And what they want to do is something like a Q-tip trust, where take care of my second wife for life, but then upon her death, it goes to my kids from the first marriage. So what are the strategies you could use? One is leave the IRA as the spouse, but buy some life insurance for the kids from the first marriage so they get something when daddy dies. The second is to perhaps split the IRAs. Some to my surviving spouse, some to my kids from the first marriage. And here's where we run into our first issue of how 401k plans are different than IRAs. Under federal law, if you have an employer plan, it does not matter who you name as a beneficiary on the forms at work. it does not matter. As a matter of federal law, that plan will go to the person you're married to when they die. So federal law trumps the beneficiary designation. With a profit sharing plan, with ESOP, with any kind of employer plan, your beneficiary designation form is void. It will go to whoever you're married to, unless the person you're married to signed a waiver and consents to having it go like the kids from a first marriage. So that's the way out with the employer plan. As a matter of federal law, it doesn't matter who the beneficiary is. It goes to the person you're married to. The exception is if that person you're married to signed a waiver. So this is a lot to handle. We're going to talk about how you plan for this. Let's now take our second break, our 10:50 break, and we'll resume at 11 o'clock to deal with these marriages. So enjoy your break, celebrate, and then we'll come back, wrap up, and I'll get you out of here by noon. Thank you. We'll start in 2 minutes. Okay, we'll start in a minute. Before I do, I just want to take the opportunity to thank Joe Dilla at First National Bank in Sioux Falls. It's been such a great help to sponsor this, and thank all of his team and Nicole and everybody who's been such great help. I do hope I can someday return to South Dakota. I was there years ago, and I stopped at a museum, picked up some artwork, um, and also you have this incredible collection of musical instruments that someday I hope to visit. So you live in a remarkable place, and you're good people, and I'm just really, really thankful that I could be with you today. And hopefully we won't have this COVID thing, and hopefully we won't have a shutdown. During the shutdown, we have a lady who cleans her house, and she couldn't come to the house. So my wife and I went around the home with an iPad, and she used to tell us where we have to scrub harder, and then we cut her check. So it was a tough time. Also, my kids this summer, my kids signed up for Dad's homeschool day camp. My kids enrolled in Dad's homeschool day camp, and after one day, every one of them transferred to Mom's homeschool day camp. It was a tough summer. Well, let's pick up here. So, with an ERISA plan, it doesn't matter who a married person names the beneficiary of their retirement account under forms. They name kids from a prior marriage. It's going to go to whoever they're married to at the time of death. So, again, 401k plans are governed by federal law versus IRAs are governed by state laws. So here's the legal rights. Regardless of who a plan participant named as a beneficiary of a 401a account, 401a is pension, profit sharing, stock bonus, ESOP, 401k, the surviving spouse is entitled to 100% of the assets in the account unless that spouse executed a waiver. By comparison, IRAs are generally subject to state laws, including your general divorce and community property laws. What is the state law that applies to assets in a trust? An IRA is either a trust or it is a custodial account that operates like a trust. It's got beneficiaries and things like that. So what's this waiver you have to get? A spouse may waive the privilege to receive the entire account balance by executing a qualified waiver. Also, if the worker is going to do anything that reduces the balance of the account, you're going to have to provide a qualified waiver for that. For example, the worker wants to borrow money. Well, now there's less money to plan that could go to the surviving spouse at death. The spouse should sign off on the loan or the hardship distribution or anything else. So, prenuptial agreements are ineffective. And the lawsuits, there's plenty of them. In a typical second marriage or something like that, you do a prenup, and they say, all right, well, his retirement assets can go to his kids, her retirement assets go to her kids. They sign the document, and there's the contract, a prenuptial agreement. His kids get his retirement assets, her kids get her retirement assets. One of them dies. It goes to surviving spouse. The prenup is ineffective, even though it's a contract. Why? Because it's not a valid waiver. To be a valid waiver, it has to be signed by a married woman or a married man, and the prenup is signed before they are married. So how do you deal with this when you do a prenup and you do want each person's retirement accounts to go to the respective children of the people? You add a clause to the prenup that says, and all parties agree to sign such documents as are necessary after they are married to implement the terms of this prenuptial agreement. And there's plenty of court cases out there where the prenup said it goes to his kids, his assets go to his kids, and his assets went to the second wife as a matter of federal law. And even a lawsuit from the kids against her, she's likely to win. So to be a valid waiver, it has to be signed by a married person and witnessed by notary public or by a time rep, but typically it's a notary public. What about second marriages, 401k versus IRA? In 49 states, if you draft a will and you say, this goes to my wife, and then they get divorced, but they never update the will. It's expensive to go to lawyers and things like that. So when the person dies, it's still named the wife as the beneficiary of the will. In most states, the ex-spouse will not take. They pretend that the ex-spouse has died. It'll go to the beneficiaries that are after that. And some states like Minnesota, your neighbor, are expanding this to non-probate techniques because you don't want to go through probate. And so we put everything in a trust, and then we name the ex-spouse as the beneficiary. At that time, the spouse, then they get divorced, and never update the trust instrument. They'll say the same rule apply for that. So in most states, the former spouse will not receive under the will unless there's some sort of intent from the decedent that they did want the ex-spouse to get the property. And so we have a court case where a man has a retirement account. He's also got life insurance and other fringe benefits at work. And he had a second wife who he divorced. And when he died, the second wife was still named as the beneficiary, and there's kids from their first marriage. And they want to use this law to get the retirement assets and the life insurance. Supreme Court said no. Federal law preempts. Now, this person didn't die married. This person simply died, and on the beneficiary form, we still had the ex-wife. But we have kids from a prior marriage, and that's the natural tension of a lawsuit. And no, because when you die, it's the beneficiary, unless you're married. If it's married, it goes to the spouse. If you're not married, whoever the beneficiary is, state law has no impact on the beneficiary form at work. So what about IRAs? So what if you have an IRA that's filled out and we name the person they're married to at that time, and then they get divorced? What does South Dakota law provide? Now, for example, in Kansas, that person's still going to take. They have to amend the trust instrument to change the beneficiary. It will still go to the ex-spouse. But in other states like Minnesota, where they try to expand sort of this testamentary issue to non-probate transfers, the ex-spouse would not take. So what is your South Dakota law in that situation? And then you just tell the client, you better update this. You should always update it, but the law won't take care of you in that scenario. So all IRAs to spouse, buy some life insurance, split the IRAs, some to spouse, some to kids. That'll work with IRAs. But then the idea here is to use the charitable remainder trust like a Q-tip trust and use it for the taxable income assets, the IRD assets. So we all know CRT, put property to CRT, pay to my child for life, remainder to charity. But this is the 2-generation CRT, which we use in second marriages. Take my $1 million IRA, have it payable to a charitable remainder trust. And so this guy who's got $4 million, remember, $4 million he has, she has nothing, says, all right, I'm going to name you as the beneficiary of $2 million. We'll do a rollover. I know you're not going to name my kids from the first marriage. But the other $2 million is going to go to First National Bank or any quality institution in South Dakota, South Dakota Trust Company, any great institution. And we will have a charitable remainder trust there. It then pays income to my second wife for life. You get $100,000 a year. But when you die, it doesn't go to charity. When you die, it goes to my 2 kids from my first marriage, and each of them will have $50,000 a year. And then when the last child dies, the $1 million goes to charity. And she says, well, what if I need more than $100,000 a year? Well, that's what your $2 million rollover is for. So instead of all or nothing, all rollover, all CRT, a split can be a way to kind of make people feel comfortable. And then he's taking care of his kids from his first marriage, but also taking care of the second wife for life. And the gender could be different, and it could be the same gender marriage. All we're doing is kind of dealing with the income tax problem income respect that the decedents had. So that's what you have here. Can be a solution for second marriages when the estate's top heavy with retirement assets, half IRA to surviving spouse, other half to CRT for second spouse and children from a first marriage. Again, no federal state tax deduction, and I got to get the 10% test. Basically, need the kids to be over age 27 or 30. It has to be chairman of a unit trust with a 5% payout or higher. No state tax marital deduction. but really you should have charitable intent. Again, I don't want to use this as a gimmick. Somebody says, I have an idea of what I would like the $1 million to be used for when my children die. I like the legacy or family name or whatever it's going to be. And then it should work well. The person says, well, if my second spouse and my kids from the first marriage all die a year after I die and the charity gets the money right away, I'm good with that. That's the client where the COT is going to work well. And then when I look at these payouts of IRAs and Conduit Trust and the like, and I look at a CRT, if you're a money manager, which of these payouts can you do the best job managing for investments? And the CRT is pretty attractive to 5% payout. So one final observation, what about the grandchildren? Anytime you have something go to charity as a bequest or charitable trust, you're disinheriting somebody. And so one way to deal with that is to get life insurance, not on the grandparents in their 80s, but on the kids in their 50s who have children who are in their teens. And the life insurance on the kids in their 50s is a lot cheaper than for the older people. And then when the charity gets the money after the kids die, we also will get some life insurance. It's kind of part of the plan. So our last few minutes together, let's talk about this explosion of donor advised funds. And why do people become philanthropists? Little Johnny came home from first grade, says to his mother, Mom, when I grew up, I would like to be a philanthropist. Oh, Johnny, that's wonderful. What made you say that? Well, they all seem to have a lot of money. That was his experience in the first grade. Now, that's better than kindergarten. When Johnny came back from his first day of kindergarten, his mother met him at the door and said, Johnny, how was the first day of kindergarten? Oh, it was okay, I think. Johnny, did you like it? Yeah, I liked it. Johnny, I can hear from your voice. There's something wrong. What's the problem? Johnny said, well, I guess I didn't learn everything I was supposed to learn. What made you say that? Mother says. Well, they want me to go back tomorrow. That was kindergarten. So generally, when people become philanthropists, it's because they have a passion for a cause. You know, there's animal shelters, there's educational organizations, but they have an idea of how they want to do it differently than what other organizations are doing. But what we're going to talk about are situations where you advise your clients, you know what, if you haven't done it before, you might want to set up a private foundation or a donor advised fund. When would you suggest that? Well, first is if the client has a lot of income this year. They won the lottery. They're selling the farm. They're selling the business. They got $2 million worth of income. When you get income that high, your tax deductions are more beneficial because you'll save money at a higher rate than next year when they go back to their normal income level. So you need a large deduction at high tax rates when there's a lot of income. Second, and this is probably the reason for this big explosion in donor advised funds, is the strategy to itemize your deductions. As you all know, under the 2017 Tax Cut and Jobs Act, it doesn't matter how much state and local taxes you pay. The most you can deduct is $10,000. And of course, South Dakota, you're one of 9 states that does not have a state income tax. But if somehow your property tax and your other taxes are above $10,000, the most you can deduct is 10. So you have a couple who has $10,000 of state and local tax. By the way, standard deduction for them is about $24,000. They have state and local taxes of 10, and every year they get $10,000 in charity. The itemized deductions are only $20,000. So they'll take the standard deduction 24. So the idea of bunching charitable gifts is that this year they contribute $40,000 to charity. And rather than give it to their favorite charities and say, leave us alone for 3 more years, they put it into a donor advised fund. So this year they get a charitable deduction of 40, and with their state and local tax of 10, their itemized deductions are 50. They get a tax break this year from the charitable gifts, and then the next few years they pay out the $10,000 a year to charities. The charities don't notice any difference in the cash flow, but this got them a tax deduction that they would not have had if they gave $10,000 a year every year to the charities. Also, for people who give to charity and who do deduct the charitable gifts, if they have investment income, the philanthropic vehicle is a way to save taxes. As you know, once your income is over $200,000 single, and only 1% of taxpayers who are single have income of $200,000. Ladies, but if your income is over $250,000 married, and 20% of married couples have income over $250,000, because Congress didn't say 200 and 400 for married couples, it said 200 single, 250 married. Once your income is over $250,000 for a married couple, your interest, dividends, capital gains, and rents are hit with a 3.8% surtax. You pay income tax and a 3.8% surtax, the net investment income tax, and NIIT. So here's somebody who gives to charity every year, and their income is like, $300,000, and at the last $50,000, they're paying the 3.8% surtax on their investment income. So the idea is, get a big charitable deduction this year, take $200,000, and put it into a donor advised fund. And just to make the math simple, let's say it's $200,000 that earns 5%, earns $10,000 a year. Well, now you just moved $10,000 of investment income off of your 1040. And then if you give away $10,000 a year, you do it from your donor advised fund, and you save the 3.8% surtax. Plus, you got your charitable income tax deduction this year. Other advantages of donor advised funds is the ability to split your gift to many charities. So the best asset to give to charity, first of all, if you're over the age of 7.5, the best asset to give is your IRA. So the best asset to give is assets from your IRA. Why? Suppose we have a person who has $100,000 in IRA and $100,000 in stock. The stock has a basis of $10,000. When that person dies, if it all went to the kids, how much is taxable to kids? Well, first, the stock has a step up in basis, and assuming your estate's under $11 million, you don't pay estate tax. So now the kids get the stock with a basis of 10. But when the kids get the 100,000 IRA, they got to pay income tax on 100. So this person says, I want to give away $100,000 to charity. It's a no-brainer. You want to give the IRA to charity. And by making lifetime gifts from your IRA, you're getting that balance down and you're keeping the stock for the kids to inherit. So if you're over the age of 7.5, the best asset to give to charity is your retirement accounts. For people who are under the age and are not 7.5, the best asset to give to charity is appreciated stock. Stock that's gone up in value. We'll go through the example in a second. And that means you should make your $100 gifts with stock. You should make your $200 gifts with stock. You can't do that. It's just too hard to do with stock certificates. So what you do is you concentrate your giving. You put all your stock in this donor advised fund. The donor advised fund sells the stock with one transaction, and now you can cut your checks for $50, $100, $200 to different charities. You also just get one receipt from the donor advised fund with magic language that says you receive no goods or services. If you give to 20 charities, you're supposed to get 20 receipts with that magic language. Makes things easier. And then you can make anonymous gifts from donor advised funds. And about 2/3 of my gifts are anonymous from the donor advised fund because I just want to do it that way. 1/3, I'd say. So that's why you consider doing this. You have a passion for a cause. And then there are tax and administrative situations that say, hey, this donor advised fund is going to be a great vehicle. And then we get back to this thing about donate what? Again, if you're over the age of 7.5, IRA is the best. Get the taxable income down that your kids inherit, get the stock up that your kids inherit. But when Bill Gates, for example, gives 10,000, well, let me go through an example. In Washington, oh, the poor people there with the smoke, which you're getting in South Dakota. In Washington State is the richest man, well, the two richest men, Jeff Bezos of Amazon and Bill Gates of Microsoft. By the way, I bought Amazon stock when it was first issued. I got the stock when it first came on at IPO. Sold it 3 months later for 6% profit. don't want to brag, but you know, I made 6% of that. Bill Gates picks up the phone, calls up his accountant. Accountant, I want to do two things. Yes, Mr. Gates, what is it? Step number one, I want to sell 100,000 of Microsoft stock. Got it, Mr. Gates. That's all going to be taxable gain. You've got a penny basis in your stock, but yeah. Step number two, I want to take $10,000 from the proceeds of the Microsoft stock, and I want to write a check to a charity. Mr. Gates, you don't want to do that. No? What should I do? Mr. Gates, what you want to do is you want to sell $90,000 of Microsoft stock, and then you want to donate 10,000 Microsoft stock to a charity. Bill Gates says, well, the cash flow is the same. See, if I sell 100 and I give 10 to charity, I'll have 90,000 in cash. If I sell 90, but I give 10,000 stock to charity, either way, I'm going to have 90,000 in cash. Why should I donate the stock to charity? Mr. Gates, it's for your income taxes. You see, if you sell $100,000 of Microsoft stock, you're going to have a gain of $100,000. And then when you write a check to charity for 10, you'll have a tax deduction of 10, and your taxable income will be $90,000. But if you only sell 90,000 Microsoft stock, you'll only have a gain of 90. But you can take an income tax deduction for the value of the Microsoft stock that you gave to charity. So you take your gain of 90 minus your charitable deduction of 10, your taxable income will only be 80. So either way, 90,000 worth of cash, but with the gift of appreciated property, taxable income is 80. Bill Gates reduces his income by $20,000 with a gift of $10,000 worth of stock. So you get two tax breaks when you donate appreciated stock. You avoid the capital gains tax on the appreciation, but you get a charitable deduction for the value of the stock, $20,000 worth of benefits from a $10,000 gift. How much taxes does that save? The answer is it depends on the tax rates. And when George Bush had the Bush tax cuts, the highest tax rate in Washington and South Dakota was 35%, and capital gains was 15%. And now the tax on investment income is 40.8% of Bill Gates, because you take the 37% tax rate plus 3.8 of the net investment income tax. And on capital gains, the highest tax rate is 20% plus a 3.8% surtax. So bottom line, in Washington, which does not have a state income tax, and in South Dakota, which does not have a state income tax, Bill Gates would save, with a $10,000 gift, save $6,000 of taxes. Saves 23.8% by avoiding the capital gains tax, saves 37% by getting a charitable income tax deduction. That's the leverage of the double benefit. So the IRS, if they wanted to try to get a tax break here, would try to do one of two things. They'd try to say, well, Bill Gates, you're going to be taxed on all 100. You sold all 100. And here's a court case that came down just this month, September, that when you transfer stock to a donor-advised fund, and that donor-advised fund has a policy that when we receive that stock, we're going to sell it, the donor will not be taxed on the sale. So this donor knew as soon as this charity got the stock, they're going to sell it. And the IRS tried to say, well, that means the donor sold the stock and the gain will be taxed to the donor. The taxpayer donor stock of a closely held business to a national donor advised fund. The charity has a stated policy that sold donated property shortly after receipt to reduce market risk. IRS argued that such a policy meant that the donor should be taxed on the gain as if the donor had personally sold the stock and just given the cash. And here in summary judgment, without even hearing any evidence, the tax court concluded the taxpayer is not taxing the gain in the charity sale. The Dickinson case, TC memo 2021-28, September 3rd of just a few weeks ago. So the last thing is, if you want to be a philanthropist, what do? Do you use a private foundation, donor advised fund, supporting org? I'm going to skip on that. That's like your Friends of the Community Foundation. And I'm going to talk about the tax laws that differentiate them and just the practical things. I'm going to get you out of here on time. The rich person can choose between a private foundation And it's going to require tax return, it's going to require administrative costs. A donor advised fund, where you basically have an account at a larger charity, very inexpensive to administer, or the Friends of organization. I think you all know Private Foundation. It's a 501c3 charity, but only one family contributes to it. Or something like Henry Ford contributed to it, nobody's contributed since. It's got endowment income. And then I'm going to skip the Friends of to get you out of here in time. But let's look at donor advised funds. A donor advised fund is a fund or an account owned by a sponsoring public charity, like the Sioux Falls Area Community Foundation, where a donor or a person appointed by the donor can recommend either grants or investments. And again, this is the most inexpensive way to be a philanthropist. The costs are economies of scale. All the costs of the IRS, the tax return, the audit by the CPA firm are all spread among the funds. They can make grants to any public charity. They're very popular. Grants from donor advised funds already exceed 40% of grants made by private foundations. So who offers them? And traditionally it used to be community foundations, like the Sioux Falls Area Community Foundation. And then in 1993, the IRS let Fidelity, the big investment house, establish a donor advised fund where people who are Fidelity customers could give to that and have the donor advised funds at Fidelity. So Schwab, Vanguard, Goldman Sachs, and others all jumped on board. There are also national charities that have donor advised funds. The National Christian Community Foundation is huge. A lot of universities like Harvard will have donor advised funds. The numbers are just staggering. The National Philanthropic Trust, they administer donor advised funds. They come up with a report every year on how donor advised funds are faring in our economy. And this is the 2019 report. The 2020 report will come out in November, so don't have their numbers. But in 2018, there are about 730,000 donor advised funds. They held $121 billion in assets. And in 2018, $37 billion was donated to donor advised funds, and $23 billion was distributed. Now, by comparison, there are only 80,000 private foundations out there. So there's 10 times as many donor advised funds as there are private foundations. But these 80,000 private foundations have 7 times the wealth, $870 billion in wealth. But the private foundations are kind of like the public. You hear about the richest 1%. Well, the richest 1% of private foundations have 60% of all the private foundation assets. The other 40% is by the 99%. So the private foundations have 7 times as many assets as donor advised funds, but they don't give away 7 times as much money. The donor advised funds are more like checking accounts. You make a deposit, you write a check, you add some more next year, you write a check. And so private foundations are more like endowments. I'll pay out 5% as opposed to donor advised funds. Here are some quick statistics in terms of number of accounts. In fact, let me skip here. They're exploding. The vast majority of donor advised funds are less than 4 years old. In 2016, there were 290,000, and now there's 730,000, and it's just going. Well, it's those people who are bunching their gifts. So the average amount in a donor advised fund is falling, and I think my family and I can claim most of that decline in average value of donor advised funds. That's what I've been doing. So we can see that the commercial houses, commercial or national, are getting the lion's share of contributions, and the community foundations are the green pie, but they're still very active. And donor advised funds receive 10% of every charitable dollar given in the United States, at least in tax returns, so they're huge. In fact, of the top 10 charities that received gifts in 2018, 6 of them were donor advised funds: Fidelity, Goldman Sachs, Schwab, National Christian Foundation, Silicon Valley, and Vanguard. So we're going to wrap up with the rules and just the ambiguity we have right now. To understand the rules that apply to donor advised funds, if you set one up, or if you have clients that set them up, it's good to understand history, because as it's been said, if you study history, you won't make the mistakes of the past. Instead, I tell my students, if you study history, you won't make the mistakes of the past. You'll do like me. You'll come up with completely new mistakes nobody's ever thought of. So the first donor advised fund was in 1931, and there's an argument between New York and Winston-Salem who had the first donor advised fund. And then in 1969, the private foundation laws were enacted. And so these community foundations held these donor advised funds where people were recommending grants. And the IRS said, don't worry, you will not be subject to private foundation laws. Your funds are public charities. So in 1993, Fidelity got their approval from the IRS. And then some people started establishing donor advised funds that were getting some bad press. And I'll just mention it by name. The Wall Street Journal started writing articles about the National Heritage Foundation in Virginia. And the National Heritage Foundation said, if you put money into your donor advised fund with us, and then your child does volunteer work, we can then pay them compensation from the donor advised fund that you parent set up. So that got some bad press. And then some athletes would set up a fund and they'd do some public speaking event, and then they'd take a compensation out of the fund. Then in 2004, the West Coast version of the National Heritage Foundation was called Zelon. And the IRS audited Zelon, and they discovered that about $1 million of grants to universities were actually when the donors took money out of their own account with a check payable to the university and used it to pay for their own kids' tuition. Big name universities, USC, Notre Dame. So they were getting a personal benefit from charitable deductions that they took. The IRS tried to shut them down, and the court refused. The court said, you found $1 million of these kinds of gifts, but they gave $41 million away for other good purposes. So you should audit each of these donors and take away the charitable deduction. So with that, Congress reacted and said, we need to punish bad behavior of donor advised funds. In 2006, the law was enacted. And there are 6 statutes, and I'm going to go through them real quickly and just address the controversies. We have the definition of a donor advised fund. We have this thing about that if the donor takes out a loan or the donor is compensated for their services to their child, it's all hit with a penalty. The private excess business holdings rules is where if you got your family business, you put it in a private foundation. Private foundation can only hold it for 5 years. It's got to be get rid of it in 5 years, maybe 10 years sometimes. And so that applies to donor advised funds. And then that donor who said, cut a check to this university, and that donor got a personal benefit, that donor is hit with a penalty for recommending it. The last thing, and if you're working with a community foundation, I want to warn you about is this last one, Code Section 170F18. This statute bugs the heck out of me. You know, to get a tax deduction from a charity, you got to get a letter back from the charity saying you received no goods or services. The entire contribution is deductible. Every charity in the country uses the same language. You received no goods or services. The entire contribution is deductible. But if you put money into a donor advised fund, you will lose your income tax deduction unless there's extra words added. And the extra words are, we have exclusive legal control over the money. Well, a lot of charities use fund accounting, like community foundations. And they have a fund that's a donor advised fund. They have a fund that's a field of interest fund for a charitable purpose and things like that. And so my advice to them is just put that language on every receipt you get, whether it's donor advised or not. Because if the IRS says, well, that's really donor advised fund, it's not this or that, the donor loses the deduction. So just with every gift, say, you receive no goods or services and we have legal control. You know, it's just the boilerplate. The donor won't care. And just go with that. So that's this fund accounting business about the donor control. So the legal definition real quickly, the term donor advised fund means a fund or account which is separately identified by reference to contributions of the donor. Set up the Hoyt fund, you set up the Smith fund, the Muhammad fund, which is owned and controlled by a sponsoring organization, which is any public charity. And with respect to which a donor or a person appointed or designated by the donor has or reasonably expects to have advisory privileges with respect to the distribution or investment of amounts in such fund or account by reason of the donor status as a donor. So everybody agrees you have a donor advised fund. There's a safe harbor of who you can cut checks to, and there's specific penalties on who you cannot cut checks to. You can cut a check to any public charity. You can also cut a check to a private operating foundation. There's about 8,000 museums and libraries that are operating foundations. You can cut a check back to the sponsoring charity. So if the Sioux Falls Area Community Foundation says we're setting up a fund to help people who are unemployed because of COVID, would you allow us to have money go through a donor advised fund to this field of interest fund? Like, if you want, we'll take that money. You can move it from the donor advised fund to the fund for the relief of people who have COVID and the like. You can move money to another donor advised fund. If you have money at Fidelity, you can move it to a donor advised fund in South Dakota. You can also cut a check to a foreign charity, like an orphanage in India. You can also cut a check to the Chamber of Commerce. But if you do, then the administrator of the donor advised fund, the community foundation, has to investigate and make sure that the orphanage in India and the Chamber of Commerce actually use it for something charitable. So you have a lot of administrative costs, and that makes it unattractive. Here's what you cannot do with a donor advised fund. You cannot cut a check to a human being. And if you understand the history of the National Heritage Foundation and stuff like that, you understand why that's there. If you cut a check, if Mother Teresa were alive today, and she says, cut a check to me because I'm going to spend on something really great, and she really does spend on something great, no exception. The check to Mother Teresa is hit with a penalty. Second, a check for non-charitable purpose. Yes, you cut that check to USC, but you spent it on your kid. Then that's not a charitable purpose. You have to give it to USC for educational purposes. And the third one, where the charity did not investigate the orphanage or the other thing, then there's the penalty that kicks in. So if a check is cut from a donor advised fund to an individual or for non-charitable purpose, the charity that administers this is hit with a 20% penalty. So a check for $10,000 goes to a person, Mother Teresa, $2,000 penalty on the charity. Then the employee who authorized that check is hit with a 5% penalty, $500. So $10,000 check to Mother Teresa, administrator's $2,000 penalty, employee's $500 penalty. And so that's this example I have here, $10,000 to fly to Asia to investigate Asian art, penalty on charity, $2,000, penalty on employee, $500. If the donor borrows money or is paid a salary, then the entire amount is a penalty on the donor. So there's a 25% penalty on the donor. Suppose, going back to my example, we're going to send somebody to Asia to buy art. By the way, that person is you, the donor. So they cut a check to the donor for $10,000. Go to Asia and buy art. The charity has a penalty of 20% because they knew they cut a check to an individual. The employee has a penalty of $500. The donor who gets the check has a penalty of $2,500. So that's what's called the disqualified person. So they have a penalty of 25%. They got to return the $10,000 to the charity. What if they don't? There's a 200% penalty. The donor has to write a check to IRS for $20,000. So the donor says, I'd rather give the charity back $10,000 than give the IRS $20,000. So there's two tiers on the donor. And then the $10,000 can't go back in the donor advised fund. It has to be unrestricted gift to that charity. We just went through this, but let me just wrap up with this last thing here of the penalty on the donor for getting a personal benefit. A donor or an advisor of the fund recommends a distribution from a donor advised fund, and the donor or a family member receives a more than incidental benefit. The clearest example, which we've actually had found, is a donor spends money on their own kids' education, and they wouldn't get a tax deduction for that. So they took a tax deduction, putting money in the donor advised fund, and now that grant is relieving them of a liability to pay tuition. Clearly, that would be a penalty on the donor. So that if a check leaves my account and goes to a college to pay my kids' tuition for $10,000, I have to pay a penalty of $12,500. There's 125% tax on the donor for having this benefit. And if an employee knew I was using it for my kids' tuition, that employee has to pay a 10% penalty of $1,000. This is different than the other tax about the loan or the grant to the donor. This is just recommending a grant that provides a personal benefit. So how do you know if you have a personal benefit? And this is where the controversy is. What is a more than incidental benefit? Now, clearly, if I had written the check myself and I wouldn't have gotten a tax deduction, clearly I got a personal benefit by getting a tax deduction for a check, like for my kids' tuition. But the IRS is now being a little more aggressive and saying that even if you had gotten a charitable income tax deduction for that gift, we're still going to prohibit the donor advised fund from making that payment. Because we look at donor advised funds as itsy bitsy private foundation. And there's some things that private foundations can't do that are charitable. And so we got this tension and we're waiting for the regulations to come. So the easy case is that the donor wouldn't get a tax deduction, like writing a letter for paying college tuition. But the two things I'm going to leave you with is when the donor advised fund pays a legally binding pledge of the donor, or if they try to split a gift, like a table at a dinner is $1,000, the meals are $200, the charitable part is $800. And so the IRS issued this notice, and this is all the materials that are attached if you need to look at this. And by way of background, a private foundation cannot pay a pledge that's legally binding, but a private foundation can pay a pledge that's not legally binding. Well, the IRS issued this notice that said it's okay for a donor advised fund to pay a pledge that's legally binding, not legally binding. The law is more generous for donor advised funds. So when you hear the on-air pledge drive for public television or public radio or whatever it is, it's okay to pay it from a donor advised fund. Now, some of them still say we will not pay a donor pledge. That's their own policy. But this is the law right now. It's official IRS policy that you can pay a legally binding pledge from a donor advised fund as long as the charity doesn't mention this is to pay someone's pledge. Just don't ask, don't tell, you're all right. On this thing where there's a table for a meal, and what some community foundations do is they say, okay, it costs $1,000 to buy the table. Send a check to us at the community foundation for $200. That's the meal. We'll cut a check from your donor advised fund for $800. There's two checks, one from the donor, and the donor has to promise not to try to deduct it, and then $800 from the community foundation donor advised fund. We put both checks in the mail, send it to the charity, and say, don't tell the donor they can deduct their gift. The IRS argues that that's a problem for donor advised funds. And so I just want to alert you to a trap before we break. They think the donor is able to go to this dinner for $200, but everybody else who bought a table had to pay $1,000. And the IRS looks at these fundraising dinners like every dinner is the Metropolitan Ball in New York City. Those of you who go to these things know that they're not the Metropolitan Ball. The charities are trying to get people in. Oh, I got to go to this dinner, whatever it is. So they don't understand how so many of them are not really that great. And this is not a proposal, but it's just to get you ready for it. So the last thing I want to leave you with is to warn you about a trap. Here's a typical fundraising thing. Charities look at these annual dinners. I mean, when COVID is gone, you can eat again. Charities look at these annual dinners as, you know, the big fundraising event. This is how we get our message across. This is how we thank the donors and things like that. They got different levels of benefits. And I don't know if you can see my mouse moving here, but down here, to get in is $150. But you could be a sponsor for $15,000, you cocktail reception at $10,000, and you can get your name on the wall for this and that much. So suppose that you want to be the sponsor of something. You want to get your name on the donor wall. It's $10,000. And you could go to this meeting for $150. Now, when you buy your ticket to just a 10, they'll tell you the value of the meal and the value of the charitable portion. For example, you buy a $150 ticket, they'll tell you the value of the meal is $50. Your $100 extra amount is a charitable contribution that you can deduct. But now you want to be the $10,000 sponsor. So you say to the Community Foundation, I would like to be the $10,000 sponsor. I will write a check for $50, the value of the meal. But I would like my donor advised fund to pay $9,950, the charitable portion, and then put them both in the envelope and send them to the charity. The IRS takes the position that that's going to trigger a 125% penalty on you for doing that. So how do you deal with that? And the answer is this. If you're going to be a sponsor and you want your donor advised fund to pay that charitable portion, you're going to cut two checks. The first is you should buy a ticket at the same $150. If it costs $150 to get there, buy that ticket for $150. And then have the donor advised fund cut a check for the charitable amount for $10,000. So don't be a cheapskate and try to cut a check for only $50. Just buy the $150. And then the $10,000 gift will not be a problem. Because with $150, you get in there to rub shoulders with everybody else. But the IRS is having this kind of weird thing. So we'll see when the final legs come out. But that's my warning for you, is if you're going to be a higher level sponsor, write your own personal check to get in at the lowest level, and then have the donor advised fund pay the sponsorship, because they don't have problems with your name on the wall and things like that. So there's some other stuff in here, and I'll just wrap up with that, because one thing I've learned is that students and people at programs like this are the only class of consumers who want to get a little bit less than they paid for. So if Joe's there, I just want to thank Joe Dilla, and I want to thank the First National Bank in Sioux Falls and the staff at the State Bar of South Dakota and the State Planning Council. I hope someday I'll be able to come up to your beautiful part of the world, but I'll just turn it over here to Nicole and to Joe.
Thank you so much. Hope to meet you someday.